about there was water torture, there was hog tying, there was shooting a gun near his head, he was in the back of the truck.
This video, leaked on social media, doesn't show any of that. But Clayton told his mom he had seen the unedited version and knew who was behind the kidnapping.
Do you think that your son was in fear as well because of what happened to Aiden?
He said, these are bad people. I said, well, Clayton, why would they share this with you? Don't you feel like scared? And he said,
well, so you would have a battery and you
too much. If you know too much, are you safe? Not really. You're a liability.
Clayton never sent his mother the video, but he did send her images like this of the two young men on a video chat, apparently right after Platursky was waterboarded. Clayton also told his mom Aiden was here for a month and went into hiding. 2 days later, Clayton never sent his mother the video, but he did send her images like this of the two young men on a video chat, apparently right after Platursky was waterboarded. Clayton also told his mom Aiden was here for a month and went into hiding. 2 days later, Clayton never sent his mother the video, but he did send her images like this. Clayton also told his mom Aiden was here for a month and went into
sometimes it means taking difficult decisions, taking decisions where you're unable to consult with a lot of people around you, where you basically have to show leadership at a short moment in time. My experience was in the financial crisis, we had to do that. And very often I saw the role of the central banks as providing collective rationale where sort of the individual rationale would have not led to a solution of the problem. And so in the financial crisis, all leaders of financial institutions behaved individually for their institution rationally, but the sum of all these behaviors would have amounted to a major financial crisis. And so the central banks had to come in as the provider of a collective rationale that basically led to a better outcome. And that's a sense of leadership where I feel that providing that collective rationale was something that many of the central banks and political leaders did at the time. And in my view, that was key for solving the crisis.
Do you remember a particular day, a particular hour, a particular phone call in 2008 where you thought, oh, this is looking ugly?
Well, 2008, we were already 1 year in crisis mode. I remember July 2007, where we had the first bank globally, IKB Bank, get into trouble. It was a AA bank, and we had to provide a solution for that bank within a short period of time over a weekend before the markets opened in Japan again. So that was really bringing everyone to the table and recognizing that the group of banks that had exposures to that single player were better off supporting that bank than insisting on the bank going it alone. And we've been having many, many repercussions like that in financial markets till we came to 2008. 2008 was the time where we ran out of individual solutions, where you gather people around the table that were banks or financial market players. At that point in time, we needed outside money. We needed taxpayer money. We needed politicians to come to the solution of these problems. And that's where in Germany, for example, we had a 500 billion program set up that really helped us solve these problems. It was very unpopular, but it was the fastest piece of legislation in the German parliament within a few days. And Chancellor Merkel, who's still the chancellor in Germany here, and Minister Steinbrück really went through all the parties. They asked me to come along, and we talked to all of the parties to get this going. That was, in my view, the most difficult time we had.
I mean, was it the most difficult day, or was it the day that you decided not to run for ECB president?
No, it was a difficult day. That was much later. I think the reaction of the ECB to the crisis had been that the ECB over time became the repair shop for a lot of, bad banking decisions, bad fiscal decisions by member states.
But that's a central bank, isn't it?
Well, for fiscal decisions by member states, you can argue that. I think there was a tried and tested avenue at the time. For example, if a member state of the European Union, in particular a small one like Greece, runs into trouble, the IMF could have been brought in to help with their programs, which are tried and tested for solvency crisis of states, solve the issue. The Europeans decided to not bring the IMF in a sole responsibility, but basically to escalate the problem to the ECB and to Brussels, to the Commission. And that's where I think it became difficult, because the resolution that was asked for involved a lot more European money at the table than really the collective rationale of the IMF. I was never a fan of that solution. And since, sometimes in life things bifurcate, since we went down that road of Europe tries to solve this problem alone, we got deeper and deeper into the problem. And the ECB still is, to some degree, the repair shop of markets and of broken governments.
But of course that bifurcation meant that you decided that you could not be actually ECB president. Was that a tough decision?
No, it wasn't a tough decision. No, I've been somebody who always felt that I'm doing a job if I'm convinced about what I'm doing, and if I'm not convinced about what I'm doing, I'll do something else. And I've been an academic for many, many years. I loved being an academic, but I felt I want to have some different challenges in the future, and so I became a policy advisor, then a policymaker and a central banker, and now I run a private organization, and I find these different traits of life exciting, new challenges, and for me, it is something that I like doing. So I'm never tie myself down to a single job that I do for the rest of my life.
So what's the piece of advice you give to interns? I don't know if somebody, wide-eyed, bushy-tailed intern and says, Axel Weber, what's your secret sauce to a lifelong career?
Well, basically when I was an academic, I was fascinated, which I said I love being an academic. I was fascinated by meeting the 19 to 24-year-olds who basically then decide how they want to have their life in the job, how much time to invest, how much education to invest. You see that less if you're at the top of a financial institution. So I go out deliberately through our younger leader clubs. I go and visit branches in where we have young people, and I keep telling them that they got to invest. They got to invest in training. They got to invest in education, and basically they got to invest in being at a very good company and getting to the top by commitment, by looking at what we call in UBS our behaviors and principles. So focus on what you're doing, be long-term oriented, and if you're in the financial services, focus on the clients, try and look at sustainability and challenge. If you see something that you think is a problem, challenge and have the self-confidence to go it your own way.
But can you, are you born a leader or can you become a leader?
I think you can become a leader. I think people are born with a set of natural instincts and with some curiosity, but it really depends what you do with these natural instincts and how you develop your curiosity. My sense has always been you got to have an inner compass. And for me, what mattered all my life was that inner compass. I don't mind if people disagree with me as long as I'm convinced that from my inner compass, I'm still going in the right direction. That's what matters. So when I ended my career in central banking, it was a deep conviction that the direction we were traveling was the wrong direction for me. Not saying it was the wrong direction, it was the wrong direction for me. And now in banking, when I came to banking, I didn't have a lifelong career in banking. It was the importance of knowing where you want to go to, focus on the long-term sustainable business parts of your business, move away from high volatility in market-based finance, and really focus on things like wealth management and retail banking as core of the bank. So it really has to come with some convictions that either you go for short-term profit or you go for long-term gains. Going for long-term gains requires a lot more commitment, it's a tougher road, and it has setbacks. You got to live through those setbacks, and I'm still committed to that longevity in everything I do.
So what's the best piece of advice you were ever given throughout your career, either young or less young, and who gave it to you?
I think I was given that by my parents, and that was trust in yourself, because in the end it has to be right for you. And that's what I always ask myself. I don't want to please anybody if I don't think that that's the right thing to do. So I have some confidence in the fact that I believe what I want to achieve. And if there are things that I see that I don't like, I say it. And if I want to help move a bank in a certain direction, I only do that if the direction is right for me. And being a leader, you have the advantage of shaping that direction. Because if you have a compass, you're at the steering wheel, you can determine the direction of your institutions. And at UBS, we have a great leadership team. So we have a dedicated group of people that all want to do the same thing, focus on longevity, really look at sustainability, and make banking better, not just as a short-term profit, but as a long-term direction.
Bill Winters, thank you so much for speaking to Bloomberg. Such a pleasure to speak to you again. Give me a sense of the overhaul. How are you settling in? How's it going?
It's been going well. We are, the thing that attracted me to Standard Chartered in the first place is a fabulous franchise, great history, really exciting markets, clients that know the bank well and like the bank a lot. This was all my sense from the outside. And I came knowing that there was plenty of problems as well. Now that's the only way you get a chance to come into a bank like this. Knew that there were problems and expected that the external environment would be challenging. So here we are, coming on a year since I agreed to join, and I guess 10 months since I did join, and it's everything that I expected. So we've got a great underlying franchise with a ton of opportunity. We had a ton of problems as well, which I tried to be very transparent about as far back as August when I made my first public statements about the bank. We set out a very robust program of actions, and we're doing it. The earnings are poor. I mean, the profitability is poor. But we said we were going to do a bunch of things, and we're doing them. And I think the market took our earnings as something of an encouraging sign, because I believe that what the market understands is what our clients have always known, which is that there is a ton of business for us to do, and that we're really well positioned to do it.
But impairments were better than expected. Is that a trend of things to come?
Yeah, Better than expected. I'm not sure what that means. Our stock has been up and down like a yo-yo, and not always on a lot of real information. But the fact is, we had overextended ourselves in a number of areas. We had some concentrations, both single name and by industry, and they happened to be the areas that were hardest hit. Probably not a coincidence. I mean, there tends to be more demand for money from people that get into trouble. We identified the problem before I arrived, and we're very transparent about the single name and industry level concentrations, and we dealt with it. So we said at the year end that we're comfortable with our portfolio. Now we know we have a lot more to do. We've got a portfolio of assets to be liquidated that are work in progress, and we had some concentrations that we're still watching. But broadly, our portfolio is in good shape.
Can you talk to us about your dividends? You've had to cut it back, understandably so.
Yeah, we don't have one right now. So we cut back our dividend at the half year last year. We canceled our end of year dividend, so zero. We did that in part because we were asking our shareholders for incremental capital, and it seemed silly to ask for 5.1 billion and pay 700 back out. But more importantly, we said this is the time to reset our thinking, and we understand that our shareholders care about the dividend. They want a dividend, and we want to pay a dividend. But we want to resume the dividend at a time when we have a visibility into our earnings and demonstrated capital strength that means that we can sustain that dividend.
So this year or not?
It's possible. We've said that we understand how important this is to shareholders, and we'll resume the dividend as soon as we think it's appropriate.
How do you increase revenue in this kind of environment?
That's the big challenge. So what we experienced over the course of last year is shrinking demand for our balance sheet at the same time as returns were being compressed, largely because of strong local competition. Mm-hmm. The good news in the first quarter is that we halted the decrease in our balance sheet and halted the decrease in income. Yeah. But the income level is still suppressed. Part of that is that we have underinvested in parts of our franchise for many years. We're investing a lot in this business right now. We're going to save $3 billion from our operating expense, and we're putting all of that back into our core franchise. Infrastructure, client relationship managers, building out in our key geographies where we have a real competitive advantage. That's the key way to get income up, is just to build productive capacity. We also know that we have a really big set of client relationship managers that were very focused on one set of measures historically. And it was really around growing income at the top line, not so focused on returns. We've shifted the focus much more towards returns, and there's always a risk that in that transition, you lose the focus on growth. I think we've got the balance right, so our relationship managers are now both trained and focused on getting that market share up, getting that client flow up. We need clients that are investing in their own businesses, and that's been the other problem.
But it's a very fine balance. So are you ready almost to take a loss for the year to make sure that you get a market share that you're happy with? Our market shares across our key geographies and products is actually very good, and it hasn't come off materially. We've seen some slippage in some markets in retail, but most of the income downdraft that we've experienced has been the result of lower commodity prices, lower levels of global trade. So last year was the first year in a long time that trade has grown at a slower rate than underlying GDP. But so you could post a loss for this year. It's not impossible. And it's not impossible. We earned a bit over $500 million in the first quarter, so we'd have to do that much worse in the rest of the year to generate a loss. So you never say it's impossible, but I'm hoping that we can grow income over the course of this year. I think we've demonstrated a good control of expenses so far. The loan impairments is a wild card, and obviously if one of the bigger exposures has a surprising turn for the worse, that could have a material impact on us. What about litigation? Is that the bulk of the costly litigation? Is that behind you? Litigation probably, but we've been very transparent about a number of open investigations that we have with U.S. authorities and with the FCA relating to anti-money laundering compliance and sanctions compliance going back to 2012 and a little bit beyond. Those are open investigations. We can't know when those will conclude. We would love for them to conclude soon, but they have to run their course. Of course, we're cooperating as fully as we can, and we're doing our own investigations. I'm comfortable from everything I've seen that nobody in the bank intentionally misled. Emerging markets have been hurt by concerns over bad debt and not enough structural reform. I asked CEO Bill Winters about his outlook on China's economy. Are you a little bit more positive on China than you were just 5-6 months ago? It seems the economy is stabilizing a little bit. Yeah. We have seen a little bit of companies going through default, but overall it feels a bit better.
Yeah, it does feel better. And I was probably never in the doomsday camp. I suppose if I had been, I wouldn't have come to do this job in the first place. But there were clearly some policy fumbles back in August of last year and then at the end of last year, beginning of this year, where there was a failure to communicate intentions with the market about the underlying equity market, the currency markets, et cetera. Against that backdrop, the actual economic activity is very good. So
if you believe the numbers.
No, you can discount the numbers by a fair amount. It's still pretty good. Although I think the numbers are fair enough. There is a clear shift towards a service and consumption-based economy. There's a growing and I think demonstrated resolve to deal with the capacity overhangs from the state-owned enterprises. A lot of the growth, I think it's real. It is the result of a substantial increase in the debt stock. And no doubt that debt stock is effectively a policy matter. So the big state banks and the capital markets are encouraging debt creation. And that, of course, is mortgaging the future. But how much of that 6.8% growth is simply manufactured through increase in debt and continued capital spending versus real underlying growth? I think that the majority of it is real underlying growth. And most of us would be quite happy with 4 or 5% growth with no incremental increases in debt stock, especially in the second biggest economy in the world.
So you're not really concerned about defaults, right? You're still quite active, or you will be quite active in China. I know you're playing RMB, for example.
Yeah, we are active in the local lending and the local capital markets. But of course, we're concerned about defaults, and there has been an increase in non-performing loans, still manageable.
They're managed, right?
They're manageable and managed. The quality of our book in China is very concentrated towards investment grade companies and very concentrated in the banks. So, and the large banks, because we're a trade bank, we're facilitating payments. So the nature of that business is pretty encouraging. But where we have a broader based commercial banking and corporate banking business, we're seeing some stresses and strains as the economy adjusts, in particular in the call it the more old economy areas. But we think this is manageable in the overall scheme of things.
What are the three biggest risks that you see out there? So I would point to China, possible Brexit or implosion of the EU, a policy mistake from the Fed, and also maybe liquidity on the markets.
My biggest concern really is that the cumulative effect of extraordinary monetary stimulus over a period of time, together with an element of fiscal stimulus. Obviously, that is differing from region to region. Cumulatively, that's building up some pretty big imbalances, and it does feel a little bit like a rubber band that's being stretched. That there's a risk of snapping, and I think a lot of the pressure on banks to increase their capital position is intended to have the resiliency to see through a bit of an unexpected shock. But so I think that's really the macro theme to watch.
But a shock like what? A possible recession, a possible, again, freezing up of liquidity in the markets, or even a systemic risk coming from a big commodity, for example, trader going under?
Yeah, I'm less worried about the systemic risks, although we should never ignore those. But I think the little wobble that we saw last year, when there was a concern that increasing monetary stimulus, in that particular case in Europe and Japan, was just having diminishing returns, and the sense that may be the only tool in the arsenal.
Although it's backfired, negative rates really hasn't worked as people were expecting.
There are consequences to negative rates. Right? We've not played this one out yet, and no one knows exactly how it ends. So I think we have to be careful of and aware of that. That's part of the reason that I'm comfortable sitting here in an extraordinarily well capitalized position with very strong liquidity, is to be resilient against some of the things that we're concerned about but don't really know how they will play out. Right. But the other risks that you mentioned are real as well. So the market obviously became very concerned about the combination of a tightening Fed and a China whose objectives were a little bit unclear.
Are you concerned and Janet Yellen has been extremely dovish, if she becomes a lot more hawkish in the next couple of weeks or months, what does that do to emerging markets and debt?
Yeah. I think the emerging markets are much better prepared for a growing interest rate differential relative to what they were a year or 2 years ago. But as we saw last year, and as we saw from the volatility this year, a little bit of jitter, a little bit of stimulus creates a lot of jitters in the market. So I think the Fed's got to be very careful. But by the same token, we've had a rate increase. I fully expect that we'll have another and maybe 2 more this year. I think the market can handle it.
What do you expect commodity prices to do?
markets, less so in some of the other markets. And I think we've probably reached a reasonable equilibrium for this supply bracket. But we continue to have growing demand. And at the end of the day, whether the 6.8% growth in China is precisely right or whether it's relatively debt-fueled, it's still 6.8% growth. And the demand for oil coming out of China and the United States, even at sluggish growth, and Europe, even at sluggish growth, is positive. So, and supply it has begun to come off and will begin to come off as the high-cost producers capitulate. So I think we'll see a stabilization of commodity prices around this level with an upward bias.
Given what you've just said, where do you see the bright spots? Because if you look at the world, so I know there's China, they're still growing. World growth is very sluggish. We've thrown a lot. Central banks have thrown a lot. Yep. And actually, forecasts for growth aren't really going anywhere.
The bright spot closest to home is that the banking system is extremely resilient right now. So we've got much, much higher levels of capital than we did just 3 years ago, much less 5 or 6 years ago, and much more liquid. The fund industry is much less leveraged than it was. So the capital markets broadly are in better shape. So I think there's a better shock absorber in the system than we've had before.
And this is worldwide?
This is worldwide.
US, Europe?
Absolutely. I mean, the US, I think, got there faster. Europe is getting there slower. The UK is in between. But I feel very comfortable with our capital position. And, we could absorb, as we did, via the Bank of England stress test last year, a pretty severe shock. And we'll have a stress test this year that will be even more severe. And I'm sure we'll absorb that as well and be able to carry on with our business. So that's one very good piece of news. Second is that most of the world is still growing. And it's not growing as quickly. A little bit. It's not growing as quickly as it did. But the underlying demographic trends in the parts of the world that are still growing are very good. So China in the short term is okay. In the long term, we know that there's a challenge. But the rest of Asia, India, which is booming, East Africa is booming. Commodity exporting Africa and the Middle East are more challenged. But across these markets, we still have growth with good underlying demographics. And this is an increasingly large part of global GDP. So I think we can get very doomsday about the risks, and there are plenty of them. There are plenty of them. And we must be ready for those risks. But in aggregate, the world feels like it has every opportunity to get back to a stable, albeit lower, level of global growth with more balance and a more resilient financial system. You
mentioned currencies. Is it the end of the dollar rally?
That's a big call. I think the dollar rally is clearly connected to the whole risk-off theme that we've had on and off, but on balance, a risk-off theme over the past year. And I think it's too early to call the end of the risk-off theme. I think we could have episodes of real risk aversion, and I think that would give the dollar some legs.
So you're expecting volatility and kind of seesaw markets and currencies?
I'm expecting very high volatility for the rest of this year and probably into next year.
I asked CEO Bill Winters what kind of bank he wants to build.
What we have today is a great international bank, focus on trade, payments, and serving the emerging affluent, both at an individual and a corporate level, in Asia, the Middle East, and Africa. Right? So we start with a fabulous franchise. We looked very hard at whether there were big chunks of that franchise that weren't critical for our future. And we've decided and recognized that we have fantastic opportunities in retail, we have fantastic opportunities in commercial banking, and we have a very strong corporate and institutional business that we want to continue to grow. So what we would like to be is a much better run version of what we are today. Now that will involve lots of ins and outs. We sold 19 businesses last year. We're selling a bunch of businesses right now. We're investing heavily in our underlying businesses. So far, all of that investment is organic. I think that's the right thing to do when we're also tightening up our controls. But there are and will be inorganic opportunities at some point. So when we're ready to deal with those things, I'm not talking big acquisitions. I'm talking about just build outs around our core strengths.
But what needs to happen to be at that point? The oil price stopping to fall, or are you looking more at Asia instead of the Middle East?
So we're doing what we need to do to get to the place where we have all the options open to us. The first was to strengthen our foundations. So that was get our capital position rock solid. Yeah. And we are just in a good place right now. Second is to really tighten up everything around our control environment. So that's risk controls, it's expense controls, it's conduct and compliance controls. Thankfully, the ethical culture in the bank is fantastic, but we were a little bit loose in terms of the way that we just kept track of things. And as a result, little mistakes got amplified, hence the very bad financial year last year and the challenge getting out of that. But we need to execute better in everything that we do. It's investing intelligently. Yeah. It's creating real long-term franchises off of our core strengths. That's what we're doing. But
how do you marry with cutting enough fat and at the same time giving it enough time to play out?
You know, our shareholders have, I would say, have been quite supportive. So we went to them with a strategic plan last year. We said that it was a 3 to 5 year plan. We set out, recognizing that we identified a relatively poor operating environment with low growth, low commodity prices, low interest rates, regulatory headwinds. And in that scenario, we said, we'll get to 8% returns in 3 years and 10% returns in 5, which is not a very exciting set of returns. So we said to our shareholders, we'd like you to invest $5.1 billion into your company, and that's what we can do for you in the short term. In the medium to long term, we think we can create real value because this is a special place. And 90% of our shareholders signed up for that deal, including me and every other member of our management team who both bought shares just with our own money, but also followed our rights in terms of the rights offering, and who further agreed in terms of this year's bonus round to forego any cash bonuses and put everything into awards that are dependent on us hitting those 150 people in the company, not just the 2 executive directors. So you've got a management team that's completely aligned with the shareholders, we're voting with our own wallets to say, we think we can get this bank to where we want it to be and beyond, but it's going to take some time.
Wealth management, for example, in Asia is a crowded market.
It's crowded.
Right. So how do you differentiate yourself? So what's your story there?
It's a crowded market, which also means it's a fragmented market. So that market will consolidate over time. And there's a role for different types of players. There's a role for the big Swiss banks who have a very strong offshore offering to ultra high net worth and relatively concentrated client segments. There's a role for local banks who are banking the emerging affluent, and that's a natural place for us. That's our retail business. And there's a role for those in between, which is where Standard Chartered fits in neatly above our retail business. So we have, for our footprint, we have an offshore offering, both in Singapore, in London, in Dubai. We have onshore offerings that are customized for high net worth clients, but also have the benefits of being a local bank with branches. We, in many cases, know the corporations that the individuals are running or owning. So we have a natural sourcing ground for private banking clients, but also an understanding of their business and an understanding of their local requirements and their local needs that's really differentiated relative to other big global banks. So, of course, from time to time, we'll compete with a big Swiss bank, or we'll compete with a local bank in Thailand or Philippines. But we occupy a very nice intermediate ground, which, as a truly global international bank, we're almost unrivaled.
How do you measure success, Bill? Is it the share price? Is it when you pay back dividends? What is it?
Look, it may distress our shareholders to know that I do not watch our share price. I don't watch our share price because it's not influencing what we're doing every day when we come into work. What we want to do every day is tighten up the ship in every way that we can, serve our clients, develop products that are relevant for our clients, understand the competitive environment, respond to it, but then get ahead of it. So we're investing for the medium to long term, 3 to 5 years. Now that said, we knew and we know that there are things that we have to do right now. We have to be very strong from a capital perspective right now. We have to demonstrate that we're making progress against each of these things that will eventually flow through to profits, because we'll lose the faith of the shareholders, even if we believe ourselves. And we tried to do that in the 8 months since I've been here. So say we're going to diagnose the problems, we're going to be transparent about the problems, we're going to tell you what we're going to do about it, and then we're going to let you track it. And we can't control the price of oil, we can't control the rate of growth in China. We can be prepared for the downside, we can be ready to capitalize on the upside, but we tell you what we're going to do, and we're going to do it. And that's what we're doing. We're doing it.
What's surprised you the most since you've been in charge? Is it your management style? Is it your team, shareholders?
You never know. No matter how well you know an organization from the outside, you never know what you're really going to find on the inside. So I came in thinking that this was a bank with a super strong ethical culture. You know, people come to Standard Chartered because they think they can help change the world. It sounds cliche, but it's true. Our brand promise is here for good. It's real. So it's genuine in the bank, and that's great to see. The flip side of that is that there was a looseness to the way that we managed the place. And I'm not blaming anybody for that looseness. I think it came from years of great success where the bank outperformed. And from time to time, I get a hard time from shareholders who say, you know, how could we have seen such a great drop in our share price? I mean, things must have been terrible. I said, well, you're the one that bought the stock at 14 pounds. You know, what were you doing then? I can tell you what you were doing then. You were encouraging management to go faster, to grow more, to book more loans, to get bigger, to get in. I mean, you, Madam Shareholder or Mr. Shareholder, you were encouraging the bank to do the things that ultimately were a partial undoing. Shareholders don't appreciate that, and I'll say what we're doing right now is focusing on what's great about this bank, what we can invest in to make it a lot better, and that's what we're doing.
Bill, thank you so much for your time.
Thank you, Francine.
Thank you. Fabulous. Thank you. Anna Butin, thank you so much for joining us here at Bloomberg. We've seen huge changes from you in the last 12 months. Are we going to see more, or are you happy in where the bank is now?
So the last 12 months have been very intense, the capital raise and changing the dividend policy, but very importantly, the governance, the people changes on the board, not just at the group, but in many of our subsidiaries and the team. So we changed the CEOs in our 5 big countries and quite a few people at the group level. You know, that is over. You know, we're ready to actually start executing on our strategy.
And so your strategy is what? Simpler and fairer?
So Santander has a very strong base. So we're present in 10 core geographies, 10 countries, and Santander Consumer markets with 1 billion people, where we have 117 million customers. And so everything, our focus going forward is going to be how to do more business with these customers. 100 million are in our banks, and only 13 million are loyal out of 50 million active customers. And so all our strategy is how can we make our customers be better Santander customers. So if I ask you, Francine, who do you bank with? You say, I bank with Santander. That is the heart.
And that makes me a loyal customer.
Be ambitious, that's only a first step. There's much more we can do with you, and there's much more you can do with Santander. But that first step is making you a loyal customer. That when they ask you, you say, Santander is my bank.
So, and no asset sales and no further capital raising.
We have huge potential just to grow with our existing customers. And so we don't need to buy. We don't need to buy. We have and we will continue to look at opportunities in our core markets.
The 123 account is something that is actually quite expensive because you give back,
yes,
right, to customers. You do make them loyal, but are you concerned that you're giving too much away? Or actually is loyalty at the moment the most important thing, because then you can grow in years from now?
We want to be the best bank, the best retail and commercial bank for our people, our customers, our shareholders, and our communities. The strategy has to make sense for our customers, but also for our shareholders. The reason we can square the circle is that we have a best-in-class cost income. We reported in June a cost-income ratio of a bit less than 47%. That is best in class among all large banks in the world. And that's what allows us to deliver great products with great prices and excellent service. Now, we're not there yet by any means, and that is exactly what we're going to work on over the next few years, is how we do that in our larger markets.
And what was so successful in the UK that you can replicate elsewhere?
Well, when I arrived in the UK, we were probably one of the worst, if not the worst, bank in the UK in terms of service. And since then, we are now ranked pretty much at the top. And that is very, very important. But also we have, I think, come up with a strategy that customers like. And so we have been the biggest beneficiary of the switching service. We are very much a challenger bank. I'd like to say this. We're a scale challenger, but we're bringing competition to the UK. And I believe that it's a product that pays an interest, gives you cash back, but very importantly delivers great digital experience, for example. And I think that is what UK customers are valuing.
And so that's what you want to be and push forward at a time, I guess, when a lot of European banks are chasing this elusive
banking for the high end, the affluent. Actually, the 1, 2, 3 strategy, a majority of the customers in the UK are affluent that are coming to us, because even though we are only trying to convert active into loyal, we're actually attracting a lot of new customers. So when I say we want to convert customers and make them loyal, we're not going to tell you not to join Santander from another bank. We welcome everybody.
Is there a bank that you look at and you want to be like a little bit? I'm thinking of Wells Fargo. Is that a right business model or not?
There's many similarities, and I think the potential and what Wells Fargo has done, I admire them a lot in the US, is not very different from what we're doing. The difference is that we have 1 billion people in our core market. So now 9, that's a big number.
Yeah.
So the potential growth, I think, is probably bigger over time.
Your share price has come under pressure. I wouldn't say significant pressure, but under pressure. How much do you think that is out of your control?
Well, I'd like, and I know this is a big ask, but I think we should be measured since we increased capital. So we did a big capital increase at 618 euros in January. And we did very well until about mid-April. Our share price was up about 16-17%, in line or better than most of our peers. Since then, there have been a number of issues. Brazilian banks are down. I think it's 35% since then. Spanish banks are down. Polish banks are down. So, it's the market. I think what's important is that we have shown very, very strong results. So our latest results, our profits were up 25%. We had increased our capital ratio to close to 10%. Cost income, I mentioned, at 47%, and return on tangible equity at 11.5%. These are our June numbers. And very importantly, after having increased our profits the year previously by 30%. So we're doing well. Unfortunately, global growth is slowing down and emerging markets are now out of favor. And so that is not helping us in our share price.
Coming up after the break, we find out how currencies and emerging market volatility play into Santander's business strategy.
Global growth will be slower, so it's obviously going to slow down. China is a big economy. But I think the important thing about Santander is we're very balanced. I think global growth will be slower, so it's obviously going to slow down. China is a big economy. But I think the important thing about Santander is we're very balanced. So 50% roughly of our earnings are coming from developed markets that are huge beneficiaries from what is going on. So, Spain, Germany, we're the biggest consumer bank in Germany with 14% market share. We have a very good business in the US, doing with good returns. We can do much better, but it's doing well. So, that provides a very, very strong buffer against all the emerging markets. I always say Santander tends to do better when things are complicated because we're more stable. When everything is doing very well, we're usually going to underperform. And again, if you look at any point in time, obviously, as I was saying, if you looked at January to April, we did really well. You look April, even January to now. So, I'm quite confident on what we can do for the next few years, in spite of emerging markets, being a bit volatile at the moment.
Talk to me about Brazil. We talked a little bit about emerging markets and the turmoil in emerging markets. Brazil is going through a really, really rough time, independently of what's happening in China. How do you see that business developing?
So our Brazilian business for quite a while actually was not performing as well as we would have liked, and that is quite clear. And I acknowledge we did not do as well as we should have for a number of years. I would say over the last 18 months, we've done much better. So we've made a lot of progress in terms of integration and cost cutting. We have de-risked the bank, which is very important for the times ahead of us. We have strengthened the management also. Recently, we've appointed a new CEO, Sergio Rial. Our current CEO has done a very good job on the team on that side. It's not going to be easy, and I think Brazil has, there's two, let's say, two possibilities. One is the one we believe in. As always, Brazil has had a number of these situations in the past. They've always taken the path of making the reforms, taking the tough decisions, which are not easy for the people, not easy for the economy, and that's what's happening right now. And we believe that's going to continue to be the case. Now, there's another scenario which is more negative, which obviously would mean more years of low growth or recession. We think Brazil has taken the right measures so far, and we are confident that after maybe 15 and 16 or half of 16, we'll see growth again. The currency has, depreciated significantly, and this will allow exports and volumes to grow, hopefully, in the next year. Not now, but a year forward.
How much do you worry about currencies? Do you have a fair value for euro? Because at the moment, it looks like it's going all over the place, and this will have an impact, of course, on Santander.
Yeah, so currencies have been positive for Santander this year. There will probably be negative effect on our P&L next year, right? Because of the Latin American currencies. So our businesses, we expect to do, very well, but we'll be dragged down by the currency when we convert our earnings into euros. We hedge our capital 100%, so that's not an issue. It's very difficult to know what the fair value of the euro is. I don't know if it's 115 or 112, 118. Usually currencies tend to overshoot. So, we had the euro at 135, 140. Clearly, that was not, the purchasing power parity was not there. It's probably more at 115. So it's roughly where we are today. If it overshoots, it could go below 1. It's very hard to know. At the end, currencies move according to productivity improvements. So it's a relative productivity improvements in the US or Europe. Again, our business in Europe, we expect to do better over the next few years because our customers are doing better. I was just with a customer in Alicante who buys a lot of things from China, and consumption is going up in Spain, and the cost of all those products they import is really going down. So they're going to be very competitive. Spain has been growing exports in a very significant way over the last 12 months. And so, that should be, that's one of the effects of the cheaper euro.
What's your main concern overall? If we have a global recession, is there something that either the markets or you think bankers, I'm thinking of regulation, are not really seeing at the moment?
Well, my biggest challenge is really executing on a strategy. So, we know where we want to go. We now need to execute. Again, we're a bank. It's not going to be as exciting as the last 12 months. It's not going to be about new people and raising capital. That is over. It's now about executing for our customers and continuing to deliver for our shareholders. And that is a big task. I always think about our people and our team. If we cannot attract the best team. I want to have the best team in the UK, the best team in Brazil. And I think we have that today, and we maybe can do a bit more in terms of building and strengthening at second and third level. But I think we're in a pretty good place. And then, of course, the macro, and I think that is the biggest challenge we all have. But as I said, the balance between developing and undeveloped at Santander. So those 10 core markets are in Europe and the Americas. And it's a split between developing and undeveloped, and that's going to give us more stability than others. So if things get quite bad, as I said before, we should do better than others. Now, we will be affected. I think you need competitive taxation. If London wants to be competitive with other financial centres, I think it's very important that the UK authorities understand how they're taxing financial institutions in the UK vis-a-vis other centres, I think with the new changes next year, we're at a disadvantage in the UK. I say we because we are part of the UK. I always say Santander does well in the UK if the economy does well. And I think, banks, and again, we are very much a challenger bank in this country, in the UK, it has to be competitive with other centres, and at the moment, I don't think it is for the next few years.
Are European banks in general at a disadvantage because we're that far behind in maybe getting our act in order, because we're possibly looking at more QE also from the ECB, that hurts your margins?
Well, the US did all the changes, the UK has done most of them, continental Europe, the rest of Europe is sort of in the process. This has a cost, and so QE needs banks that can then transmit QE to the economy, right? Yeah. So we can make loans and give you a mortgage and fund a startup. Because regulation has still not been implemented in many aspects, so there's still I think I was told in Brussels a few days ago, there's still 300 pending pieces of legislation in banks. I heard the number of 400. So let's say it's between 300 and 400. This means that banks are going to be holding back a bit, even though we're increasing lending. For example, we are increasing lending in Spain right now. But I think there is a drag effect because of this uncertainty and because this regulation is still in the process of being implemented.
You mentioned the US. There are concerns around the US because the Fed failed the stress test on Santander. How are you addressing it?
So I want to say it's not just the Fed, is that we need to meet our own very demanding internal standards, and we're working very hard. The first thing we did is change the team and the governance. We have a new board in the US, a new chairman at the holdco level, a new chairman at the XAUUSD level at Santander Consumer, and a new team. So I believe we now understand what we need to do. And our aim is to show significant progress next year on the regulatory agenda. Yeah.
But you're keeping it. There's nothing up for sale.
We're absolutely committed to the US. It's a great country. In spite of the regulatory difficulties, our return on equity in the US is 8.5%, which is not that bad, right? It covers our cost of equity. Our aim is to get to 11% return on equity. But as I said, very importantly, is to meet the regulatory requirements and our own standards.
Do you worry about disruptors, about new entrants? And I know you were saying that the recent research shows that only 2 people out of 10 actually want an only online experience. But how much do you look at the competition? You were talking about offering, for example, Apple Pay as a service.
Apple Pay is not a good business for Santander, but it's a good business for my customers. So I think eventually it will be a great business for us. So we launched Apple Pay in the UK. We were the first group, and our customers love it. And we did it because a significant proportion of our Santander UK customers had an iPhone. So we thought we have to offer them Apple Pay as soon as we can. What is interesting is that we now developed a great app called Spendlytics around Apple Pay, which is making customers more loyal to Santander because you can see where you spend money. It's a great tool, and it's very popular. So I think we need to continue to innovate, and I think that is the key thing. Having said this, I think the important thing is, and I said this recently in Frankfurt at a meeting, we need a fair play market for all. And so the rules have to be the same for banks and new entrants. And I think this is incredibly important. So sharing information, if I share my customer information, the new entrants should share the customer information, because otherwise it's very difficult to run a business. And so I think that is the key thing.
Do you think they will? Do you think that the regulators are looking at this and understanding? Because the problem with disruptors is that they move so fast that regulators have to really understand that market.
Yeah, I think they are. And I think one of the things we're doing also is, and I think there's many of these new companies that are, which we are collaborating. Again, thinking about our customers. So we're working with Apple Pay, Funding Circle. We were the first bank to team up with them. And when I say no to a customer because my lending criteria don't accept his credit or her credit rating, we send them to Funding Circle. So I believe in collaboration with the new entrants, but not with all of them, because some of them are actually, not ready to do that. But I think we are trying very hard to work with the new entrants and also to do our own disruptive strategies.
You are considered probably one of the most influential Europeans across the globe, and in a most influential around the world list, we seem to understand that there are fewer Europeans that there should be given the population in this region. Why do you think that is?
We need more diversity, and it's not just about women. I think we need more diversity in companies, in boards, and I think women are a significant part of that diversity. I'm very proud that we now have a woman chair in the UK, a woman chair in Santander Consumer, and we're increasing, the programs to support senior women. I think it's a matter of time, but there's a lot of work to do, and I think we need to work together with the men. I always say if I get invited to an event where there's only women, you're preaching to the converted. So we need to work together with senior people in the companies to make sure that we can do something. We need to do more. Clearly, we need to do more. And I think we need to incentivize business leaders to actually do this because it's great for the business. And I'm convinced that it's going to be good, not just for the women, but good for the companies.
In 3 years, where will you be? And where will the bank be?
So we're setting very ambitious targets. So we want to be, in terms of financial targets, I think, in a very ambitious place. But very importantly, I want us to be the best bank in many more markets. So we're already the best. And when I say the best, it's the best for our people, our customers, also our shareholders and communities. I think in some of the smaller countries, like Portugal or Chile, we're already there. We want to be there in many more, about 10 core markets. And we define best, as I said, not just for our shareholders, but for all our stakeholders.
Anna Butin, thank you so much for speaking to Bloomberg.
Thank you very much.
Thank you.
The demographic time bomb. Some of the world's biggest economies, Italy, Germany, Japan, and China, are aging. They're running out of workers with potentially disastrous economic and demographics rule the world. The exact combination of young and old, workers and retirees can determine a country's economic future.
Every country has a demographic sweet spot where the majority of your population is of working age. So they're both producing and they're consuming. Great for the economy.
Well, demographics are very important. Put bluntly, for advanced economies, the more people there are, the larger the economy is likely to be, and the more power and influence they're likely to wield on the global stage. And that's why the US is a global leader, and it's why European countries club together to influence policy on a global level.
The population of the planet doubled twice in the 20th century, meaning the world was able to create more wealth.
So in 1965, there were about 3.3 billion people on the planet. Now it's about 7.3, and that's just 50 years later. So that's obviously had an enormous effect on the productive capacity of the economy in total.
But as well as growing, the world's population is aging. The average age of all the people on Earth at the start of this decade was 32. By the end of this century, it will be 42. By 2035, 1.1 billion people will be over the age of 65. This greying of the planet has potentially profound economic implications.
As the population ages, it means there are more people consuming goods and services and fewer people producing them. So simply there's just a bit less to go around. And overall that means that an economy with an aging population is going to be growing slower than it otherwise would. As aging happens, people are going to save less, they're going to spend more, and that's potentially going to push up interest rates quite significantly over the next few decades. And if you look at analysis from former Bank of England economist Charlie Bean, he says that's about to happen, well, roughly right now. We're just at that inflection point where demographics start to push up interest rates rather than push down on them.
Many of the countries with the fastest growing working age populations are in Africa or Southeast Asia.
These countries are about to enter a demographic window that is going to be very supportive of producing economic growth. India is in the early parts of a demographic sweet spot where the majority of their population is now of working age. This really helps support growth. India right now, in 2016, is projected to be one of, if not the fastest growing economy in the world. The demographic factors are a big tailwind to that growth.
But for more mature, developed economies, the demographics are more complex and potentially very worrying.
For some economies, particularly in Europe, who are extremely indebted, the slowing growth of the workforce or the shrinking of the workforce means that those debts become less sustainable. So it actually adds to pressures that those economies are facing. And in particular, you've got sort of Italy in that camp. But actually it extends to Germany as well. While that's not indebted, the demographic pressures facing Germany are actually quite significant.
These demographic currents can seem invisible and slow-moving, but they affect many of the day-to-day decisions of our governments.
I think that decisions may need to be made. Do we accept the fact that we do have aging demographics? This will create headwinds to us producing growth. Or do we accept the fact that we need to accept immigrants to rejuvenate, to make the population younger? Countries that are really old, if they want to solve this problem, has to ask themselves, how many immigrants do you let in before it actually is a cultural revolution within your country? If the way of life that you're used to is going to change.
Most divided. I don't think we get there, right? And the hope is the Secret Service is able to protect, obviously, the sitting president, the former President Trump, and Kamala Harris, and they're doing their best. And it's important to say that none of these attempted assassinations have been successful. Now, obviously, the first one was very close and very scary.
Yep.
Second one, not so much.
Let's talk about the Harris campaign. The first time, we had the Biden campaign, and the criticism at the time was that it was a one-dimensional campaign centered around characterizing Trump as an existential threat to democracy. There's a lot of criticism about that in the middle of July. Does the Harris campaign have enough facets to it? Is it a multifaceted campaign that they're not relying on this single issue, that they can back away from talking about this a little bit more?
Yeah, I think they can. The issue with the question of democracy as a campaign issue is that it's, 100% of people are worried about it, but it splits 50-50, right? Republicans are worried about how Democrats are a threat to democracy. Same thing, vice versa. So, did it incite the first attempted assassination against Donald Trump? We're not really sure. Who knows? The motives of that shooter remain unclear. Yeah, I think they can. The issue with the question of, can the Harris campaign do more? They better, right? Because I'm not sure they're going to win on this single question of democracy. They have to win on abortion. There's more messaging around a middle-class economy, an opportunity economy than we saw from Biden, who didn't want to talk about the economy at all. So Harris is doing more. I think she has to do more to win.
Talk to us about how Harris is addressing the U.S. economy, because we all saw that interview going into the weekend. It wasn't impressive. Some very simple questions that weren't really answered. What is the opportunity economy? What are the policies behind it?
I think the policies that she wants to highlight first and foremost are the housing policies. After that, it sort of falls off, right? And I think what's important about these policies, what many of us know, is that not a lot is going to get through Congress. So it's not as though she can promise, huge reforms, huge changes, because if she sits in the seat, if she wins the election, she's very likely going to have a divided Congress. And I would agree, John, that the interview on Friday, not all that impressive. I think it's probably why we haven't seen her do a whole lot of interviews, why we probably won't see her do a whole lot of interviews between now and November. On the one hand, she's a candidate who absolutely turns out the base. On the other hand, maybe that they want to do their best to insulate her and just maintain the momentum that they have. Certainly that she won in the debate on Tuesday night.
Just quickly, just to wrap things up, base case for you and the team, what is it? Does it remain the same?
It remains the same. 65% chance Harris win. So we think that's base case. With a divided government, the Senate goes red, the House goes blue, and that really limits what Harris is able to do, at least until the midterms.
OK, Rob, it's good to see you. Thank you, sir. Appreciate the input. Rob Casey there of Signum Global Advisors. If you are just joining us, equity futures now totally unchanged on the S&P 500. Let's take the opportunity, just a few minutes, to get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Israeli Prime Minister Benjamin Netanyahu is warning the Houthi militant group that it will pay a heavy price after a hypersonic missile landed in central Israel over the weekend. The Iran-backed group fired a missile that evaded interception by Israeli and U.S. forces. No deaths were reported, but it marks a setback for Israel's air defense system. A string of misses from economic data out of China, especially on industrial production. Now, the calls continue to mount for Chinese authorities to increase stimulus if they want to hit their 5% growth target. The PBOC has indicated that there's more, at least monetary easing ahead. Goldman, Citi, and Morgan Stanley are all among the banks that have downgraded their forecast for China this year. Boeing's credit is at risk of being cut to junk by Moody's. On Friday, the ratings agency placed the plane maker on review for a downgrade. Boeing has $45 billion in net debt, and it's been bleeding cash after paring back output following that near-catastrophic Air Alaska incident in January. The Moody's announcement comes as Boeing workers strike further, and that threatens production and cash flow. That's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, betting big on big rate cuts.
As we start to see a little bit more loosening of financial conditions, that's going to be helpful for equities broadly.
That conversation just around the corner. Live from New York City this morning. Good morning.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Five-day winning streak on the S&P 500, the longest since the middle of August. We closed that five-day winning streak on Friday. Let's see what we get this morning. This morning we look like this, just about positive on the S&P. The outperformance on the Russell, the small caps. The small caps last week, a gain of 4.36%. Quite a nice week of gains for the small caps in America on the week last week. Under Savannah's this morning, betting big on big rate cuts.
Whether we get 25 or 50, the point is that we're starting on the journey. So as we start to see a little bit more loosening of financial conditions, that's going to be helpful for equities broadly. Assuming we don't have a recession, that we do see a soft landing, you could even see markets slightly higher than that.
So here's the latest this morning. Stocks coming off the back of the best week of the year as investors gear up for the Fed's big decision on Wednesday. The central bank expected to cut rates by at least 25 basis points, with some traders preparing for a larger 50 basis point move. Laurie Calvasino of RBC joins us now for more. Laurie, I know the house view is 25, and I just wonder if we get that 25, and of course, welcome to the program, by the way. If we do get that 25, how vulnerable certain trades like the small caps actually are?
Hi, John. So thanks for having me. Look, I think it's a great question. And we were watching the small caps just surge on Friday as the renewed optimism about the 50 basis point cut came up as well. And look, I think small caps have a lot going for them. But the reality is that valuations are full and positioning is also full. If you go back a few months ago, they looked underowned. They looked cheap. We're just not there anymore. And now we've got a lot of Fed optimism baked in. So I do think in the short term, at least, if we're just thinking about the week ahead, I do worry a bit that if we get the 25 rather than the 50, which propelled small caps to these great heights on Friday, that there could be a bit of a reversion in the small caps. I think that, we really have sort of more of the fast money crowd sort of driving that trade right now. If you look at recent flows into small cap, they have been all passive driven, and that passive money does tend to be very, very fickle.
You have a nuanced view here, Laurie, with respect to not only how much the Fed cuts, but also the economic data behind it that needs to keep this going. There was this feeling that the Fed was on track to cut by 50 basis points without real pain visible in the U.S. economy. How much is any kind of weakening, even if not a recession, sort of a bear case right now for small caps?
So I think that small caps really need the needle to be threaded. And what I mean by that is if you go back and look at past cutting cycles, small caps do really, really well and embark on a longer term outperformance cycle if you get a recession, if you break the economy. It's small cap 101 to say you sell them on the way into a recession, you buy them on the way out. And you tend to see that pivot midway through. But if we don't get that and we get some sort of economy that's still growing, I do think it depends on what kind of growth we get. And if you look at the other side of the equation, we really do need a hot economy, above average GDP, for small caps to really keep going if you look at recent trading data since, say, 2015, 2016. And if we're just, I think it comes down, Lisa, what do you mean by soft landing? A soft landing that's looking at like 1.5% type GDP growth, maybe even 2%. I don't think that quite cuts it for small cap. I think you need something more like 2.5% to 3% or better.
When you broaden out beyond small caps, you say you remain neutral on the S&P 500 as we get closer to your year-end target. You talk about sentiment and how it concerns you. Can you explain why investor sentiment right now is a red flag?
Sure, it's a great question, Lisa. And look, I would say if you look at AAII net bullishness, I think that's the best barometer. It's been doing the best job the last couple years at calling short-term inflections in the market. And it's really flirting with danger if you look at where it's been recently. It's been kind of hovering right around that 1 standard deviation mark, poking above it on certain weeks, but not quite on the 4-week average. And that's very similar to what we saw back in July. That's very similar to what we saw back in August of last year. And if you look at CFTC data, which is going to give you more of an institutional look, that data just continues to make new highs. And it's above levels that we were at in early 2018 and early 2020 pre-COVID. And it's well above the highs that we've seen mark the peak in recent years in kind of that post-COVID era. Look, sentiment and positioning are not the only thing that drives stocks, and we certainly can stay overbought for quite some time. But I do think it tells me that we're really not sitting here in a position where we can absorb any kind of bad news easily. So those are charts, frankly, Lisa, that keep me up at night, even though we've had a more constructive view on equities overall.
Laurie, do you still see a connection from a Trump win and small caps rallying?
It's a great question, Anne-Marie. So, if we look back to 2023, 2024, we really just haven't seen that linkage, right, where Trump's doing well in the betting markets and small caps are outperforming. We've really seen Trump more closely aligned with large caps, with growth. Things are starting to change there a bit recently, so I would say we'll have to watch the data. One of the things we did mention in our piece this morning is that if the Harris corporate tax increases, raising the rate from 21% to 28%, were to go through, I do think that's a negative signal for small cap, because if you go back into the 2016-2017 period, small caps were one of the big beneficiaries of the rate cut. And that's not just to simply say the historical playbook, flips on its head. We have to go back to the why. And what we found back then was that small caps were more direct payers of the headline rate. They had a tougher time managing their taxes lower than large cap companies did. So I think that issue may come up if we end up seeing Harris win and those corporate tax hikes are on the table. Of course, I think that really only happens, in a Democratic sweep scenario, which is not really our base case.
Lori, you've been looking at both these candidates' plans. I saw you at Trump's economic speech here in New York City. What big questions are still missing as you think about and you put these into your models?
So, look, I think it's really preliminary for both candidates, right? I think that they've both taken some heat for lack of detail. From my perspective, maybe my expectations are just low all around. I think this is maybe the 5th or 6th presidential election I've covered as a strategist. But I'm really just looking for kernels of where they're leaning, of what their wish lists are, of what their impulses are. So I think, when I look going forward, I think maybe on the tax side, for corporate taxes at least, we have a little bit more clarity on the Harris side. I left the speech confused about exactly what Trump wants to do in terms of further tax cuts, the commentary of linking the 15% rate to domestic production. I don't exactly know how that shakes out in the S&P 500. We have lots and lots of companies that are producing things overseas. So I think it's tough for me to sit here when I'm looking at my earnings model to just bake in a 15% corporate tax rate. I think it's much more complicated than that.
We feel your pain for policy on both sides. Lori, thank you. Lori Calvasina of RBC. Lori saying at the start of the year, this whole conversation was like staring at the sun. It feels like we're staring at the sun. November 7th. Why is November 7th so important? I really do believe there's a chance we look back on September 18th as the relatively easier decision for the Federal Reserve. November 7th is the next Fed meeting after the one this week. On November 7th, they'll have a much better idea of the politics and policy for 2025. Setting policy around that could be quite challenging.
Especially since what is the policy going to be if they have to pass legislation? How can they extrapolate out some of the promised proposals versus what is actually going to come to pass? And then how politically motivated are they accused of being if they move in accordance to what they expect may or may not happen with respect to inflationary or deficit increasing policies in 2025?
They'll have a lot of answers on November 7th, but they will not have them all. To Lisa's point, the composition of Congress and the backroom dealings of when it comes to the tax cuts, trying to get them through. What are they going to allow potentially to just sunset when it comes to the former president's tax cuts? But then you have to look at the White House. And whether or not it's Trump or Harris, the Fed will have a lot more answers on tariffs. And whether or not they are going to be used potentially as a carrot and stick approach of former President Donald Trump, or will they be walls up almost immediately, which many people say is very inflationary, and potentially you could see the Fed thinking about hikes.
Adam Poston at the Peterson Institute making that point. He thinks we need to get ahead of this conversation. We'll try and get ahead of this week, a big week ahead. Coming up next, Neela Richardson of ADP saying don't take disinflation for granted. That conversation just around the corner on the S&P 500, slightly negative on the S&P, but only just. We're basically unchanged on the S&P 500, coming off the back of the best weekly performance of the year so far on the S&P 500 from New York. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Quite a start to a big week ahead. Live from New York City this morning. Good morning to you all. Equity futures on the S&P just turning negative, just a touch. The outperformance again on the Russell, the small caps up by 0.6%. The run of gains on the S&P, though, pretty impressive. 5 days of gains on the S&P 500. Lisa, the best week of gains so far in 2024.
And it was multifaceted. It was driven actually by the big tech names. It wasn't just small caps. It was everything. You saw the best weekly performance for this year for both the S&P and the NASDAQ. That said, how much is it banking on a 50 basis point rate cut for the right reason, which is the Fed's just going to do the right thing, according to one luminary on Wall Street, because ultimately it doesn't seem like there was real weakness behind the Fed's sort of seeming shift, or at least the market's perceived sense of the Fed's shift with respect to how big the rate cut will be on Wednesday.
Got to define what doing the right thing means on Wall Street. Doing the right thing on Wall Street means whatever I think the Federal Reserve should do. That's doing the right thing on Wall Street.
Is that what you're saying about Michael Feroli over at JP Morgan?
I'm just suggesting that if you're forecasting 50, you probably believe 50 is the right thing, correct?
A lot of people think that 50 is the right thing. I'm going to deflect completely. Greg Ip over at the Wall Street Journal writing an editorial on this. You have others as well coming out and talking about how it is the right thing to do at a time where the baseline rate is too high for the overall economy. Question will be, how much more does the market move if they do go by 50? So is that basically going to be effectuating some kind of 150 basis points of rate cuts for 2024 if you go by 50 on Wednesday?
You're right to suggest it was the everything rally because it felt like it. Nvidia was in the mix. Ally Financial and their concerns feels like a lifetime ago, given the S&P 500 and the gain it had to close out Friday.
There was this one report I was reading about whether Ally was an anomaly or not. And if you take a look at some of the other lenders in a similar sphere, they didn't see the same kind of sell-off. It seemed like the market viewed Ally as sort of an outlier with respect to its risks, and they didn't give guidance in terms of how much they expected their delinquencies to increase. Still a big question mark at a time where people are saying corporations have plenty of capital. Consumers, around the margins, some signs of fraying.
Bank earnings about a month away. Let's switch at the board and turn to the bonds. 2-year, 10-year, 30-year sit at the front end of the market. The two-year yield was down last week by around about 6 basis points, declining given that we already had hot CPI, hot PPI and decent jobless claims numbers. It's kind of surprising that the bond market was still bid at the front end, which I just think speaks to the bias to buy in this bond market, regardless of what the data looks like at the moment.
Are you suggesting that people were baking in rate cuts without necessarily economic data to justify it?
I might be knocking on the door of that suggestion.
Well, that seems to be what basically was really supporting risk assets, because essentially you are correct. Ding, ding, ding. We saw the lowest rates on the 2-year going back to 2022. And why? Entirely because some people said of basically a regurgitation of some points in the Wall Street Journal and the Financial Times that hinted at maybe this being an active conversation about a 50 basis point cut on Wednesday. Look,
Bottom line is, it really has to do with the projections out. I want to lean on what Deutsche Bank was saying and something that conversation we've had here. It doesn't matter as much 25 or 50. It matters the trajectory and the dot plot. We're going to be talking a lot about that.
We will.
And some of the guidance in the press conference.
And the dispersion as well as some of the forecasts, how wide the range is on the FOMC. This is unlocking another leg of dollar weakness. So dollar yen broke 140 for the first time this year, trading in the 130s for the first time in 2024. Dollar yen down to about 140 flat right now, Lisa. We're negative 0.6%. So that's some Japanese yen strength on the screen. That's some euro strength on the screen. Euro dollar 111.28.
And how much is this baking in a 50 basis point cut for the Federal Reserve that will add to this dollar weakness? And how much is it just that you have a Japanese economy moving in the opposite direction? The Bank of Japan on deck potentially on Friday to hike rates again. A lot of people don't think they're going to, but they're poised to again. Are we at peak dollar weakness for the moment, or do we see a lot more? Note after note, dollar weakness is probably not going to be that much more pronounced, but that might be the gradual trend going forward.
It's the bulk of the move behind us. A conversation on that in about 15 minutes' time. Under surveillance this morning, the FBI investigating a second apparent assassination attempt on former President Donald Trump. Secret Service agents opening fire at a man with an assault rifle at Trump's West Palm Beach golf course just yesterday. A suspect identified as Ryan Ruth is in custody. Donald Trump is safe and unharmed. Thank goodness.
Thank goodness. We'd be having a very different conversation today if that Secret Service agent inside the golf course didn't see this rifle poking through the fence. What kind of conversation would we be having this morning? This individual is about 300 to 500 yards away. I think what's really coming into focus now is how to protect the former president, given this is the second assassination attempt on his life. The FBI is involved. This is going to go to the federal authorities. But really what came into focus yesterday was what the Palm Beach County Sheriff said, which was that potentially the parameter by which the Secret Service has in terms of protecting the president would be bigger if it was a sitting president. Joe Biden has come out and said, though, that they want to make sure that he's given every protection and precaution necessary.
Another shocking turn of events over the weekend. We'll be in touch with the team down in Washington all morning. Any updates as we get them, we'll share them with you. I want to turn to this story. Jeffrey's saying possible Volkswagen plant closures this year could pave the way for more than 15,000 job cuts. The automaker could close production facilities without needing approval from the supervisory board, leading to possible provisions of as much as $4.4 billion in the fourth quarter. This all according to the analyst, Lisa, over at Jeffrey's.
And shows the heightening concern over in the German auto manufacturing sector as you do have this increasing pressure from Chinese manufacturers and others. I spent some time with Mario Draghi's memo over the weekend, and this idea that he kind of wants Europe to embrace a U.S. type of model in order to avoid some sort of stagflation, stagnation. The difficulty in doing that with all of the red tape and with the pushback that you've got, what is the logical outcome if they can't? And really that, I think, is what you see a lot of these automakers struggling with.
Also, potentially, how much is this a negotiating tool? This is from a memo from Jeffrey's. They're citing comments from VW made during a roadshow in North America. Quote, unions should feel pressure to reach new agreements while VW will be in a position to force layoffs. So potentially this brings more people to the board because we know that the union is on the supervisory board.
There is a lot of excess capacity in European auto manufacturing right now, and how that gets resolved, reconciled over the next year or so could be pretty brutal. Elsewhere, investors preparing for a big week ahead with the Fed taking center stage on Wednesday. Fresh economic data also in the pipeline with retail sales tomorrow and jobless claims on Thursday. Neela Richardson of ADP writing, it would be easy to ignore the economic news this week and pay attention only to Wednesday's Federal Reserve vote on interest rates. I caution you don't. Even with a Fed meeting on the calendar, there will be much more important data news to watch. I'm pleased to say that Neela is with us around the table. Neela, good morning to you.
Good morning.
Let's start there. Let's start beyond the Federal Reserve decision. Jobless claims Thursday, retail sales tomorrow morning. What are you looking for?
The strength of the consumer. What's unique about this potential cutting cycle? First of all, the Fed hiked rates 11 times. So this could be a really long game. It's not just a one and done move, as we all know, and we don't know how long it's going to take, but it's going to depend on the strength of the consumer. And so when you look at retail sales, when you look at consumer spending, the bulk of the economy, if the consumer is still holding up, what that means is that the Fed is going to be cutting into a pretty good economy. And we don't have a lot of benchmarks for what that looks like.
How would you characterise where the economy's at currently? If I look at the data and just the levels, we can get to the change and how important the change is, but the levels are still pretty decent. Unemployment around 4%, jobless claims in at around 230. If we listen to the companies, some of the consumer-facing companies have been warning about a weaker consumer. Dollar General, an example of that. Ally Financial last week, a decent example of that. How are you seeing things?
If the Fed was in this economy 15 years ago, I think we'd have a different conversation. This is a pretty good economy. Yes, there's some things to be concerned about. I'm really concerned in the jobs market about how segmented the concentration of hiring is, how weak manufacturing is. For the consumer side, I am concerned about the very low savings rate, very much lower than historical averages. I'm always concerned about housing in this economy because it's such a driver of inflation. But when you look at these jobless claims that'll come out on Thursday, I think what you'll see is pretty moderate low levels of initial jobless claims signaling layoffs. What we're not seeing is big job losses. That's unique in a Fed rate cutting cycle.
Some people might argue that's a lagging indicator, and we don't see the layoffs until it's too late for the Fed to act, which is one of the big arguments why doing the right thing means cutting 50 basis points on Wednesday. The note of caution that you had in your recent writings was household wealth as well as housing prices, and how that indicates a very different consumer in terms of resilience than some of these other peripheral weakening data points that people point to. Why is that?
Yes, the criticism with the Fed is that they always act too late, and that's why the job losses are a lagging indicator. But yeah, in other times when we've seen this huge increase in home equity, and we have, homeowners are sitting on record levels of home equity because of rock bottom mortgage rates before the pandemic and super high house prices. That's really driving a big explosion in household wealth. Well, in previous times when equity was this high, what households did was they just refinanced, tapped that equity out and bought cars, went on vacations, paid off student loan debt. They did all these things that actually leads to more consumer spending and gives a pop to the economy. Will they do those things again when mortgage rates come down, when it's less costly to refinance? I think so. You're sitting on a lot of wealth. That wealth could be an ATM for future, especially if savings rates are down. And housing wealth is a little easier to tap into than stock market wealth. More households have access to housing wealth. Home ownership is at around 65% in this country, which means that a lot of people are sitting on some money, and they may want to access that to fund their spending and purchases.
That said, some people might argue that this market is already priced in well more than 50 basis points of rate cuts. And what you see in the actual benchmark rates that are the borrowing costs, the pegs to a lot of borrowing costs for consumers currently, they already reflect that. So why not just do it and then allow things to sort of evolve from here? Do you see any real reflationary type of pressure kind of building in markets that should really push back aggressively against that idea?
I think one comment during those Jackson Hole meetings that was played but maybe ignored this week is President Harker's comments that the Fed needs to commit. It's not just about this 1 month. It's about the commitment that they illustrate over the next several months. And if they commit to a moderate rate cutting cycle, I think that will give some ease in terms of the market's ability to project the next move. If it seems like we're going to be data dependent, we're going to watch each month, it might be 50 basis points next month or the month after, maybe we pause. If there's some uncertainty, I think that's going to cause a lot of gyration in the market.
Neela, when you say there's no foregone conclusion on inflation, you point to housing.
Yes.
And then you look at, say, Kamala Harris's housing plan of a $25,000 subsidy. How inflationary is potential policies like that?
I don't really think they move the needle, and here's why. The demographics are behind a housing tailwind. If you look at the demographics in this country, Gen Z, millennials reaching peak home buying age, there's plenty of demand. You don't even actually have to amplify it. What there's lacking is supply. That's the issue. And so you have to have that two-tier housing plan. I think there's been some good plans that both meet supply and demand, but without inventory increases, we're not going to solve this issue of very low vacancy rates. We are at like half the historical rate of vacancies. 0.8% of all housing is unoccupied. That's super low. And that means housing is going to continue to put pressure on prices and inflation.
I guess one of the big issues, though, is that you can get the subsidy quicker, potentially, than there actually would be
mean, it's short-term, long-term. House prices are really high. They're unaffordable for many people. And they're unaffordable because of high mortgage rates. We might get some relief on there. They're unaffordable because people can't save because housing costs are so high. So you need a down payment. That might be helped by a little bit of money coming their way in terms of a down payment. And they're unaffordable. The big reason why it's unaffordable is because of inventory. So that is the big picture solution that has to be solved.
Just to put a bow on it for the people tuning in, 25 or 50 Wednesday?
I think it's 25.
25?
I know. It's controversial, but I think it's 25.
25 became controversial in the last week. It's something, isn't it, how things have shifted. Neela Richardson there of ADP, and of course a Bloomberg contributor. This just in from the former New York Fed President Bill Dudley, the Fed should go big now, and I think it will.
And this, to me, follows some of his previous comments. He explained why. He said that there are two objectives to the Fed's mandate: price stability and maximal sustainable employment. Since they have come much closer into balance, it suggests a neutral benchmark rate by the Federal Reserve. They say they remain far from it, and therefore it matters getting there quickly to try to stave off any kind of increase in unemployment. And he said the goal is to give a better sense of the destination rather than the pace. And if you move quickly and you get there quickly, that will actually have a much more beneficial kind of effect on the overall economy.
Things are so finely balanced. We'll keep returning to that article. It's on Bloomberg Opinion this morning. We'll come back to that in about 5 minutes' time. Equity futures on the S&P 500 just about unchanged, with an update of stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Donald Trump is reportedly safe and well after a second apparent assassination attempt. Authorities took a 58-year-old man into custody at Trump's golf course in West Palm Beach, Florida. Secret Service agents had spotted an AK-style rifle barrel sticking out of a fence about 400 yards away from the former president, who was playing golf at the time. U.S. and British officials are increasingly concerned that Russia is supplying Iran with nuclear weapons technology. Western officials tell Bloomberg that they fear the Kremlin is trading nuclear secrets in exchange for ballistic missiles to use in its war with Ukraine. President Biden is set to meet with Ukrainian President Vladimir Zelensky at the UN General Assembly next week to discuss his war strategy ahead of the U.S. election. Disney and DirecTV have reached a contract that will restore customers access to Disney-owned networks like ESPN and ABC. DirecTV agreed to pay market-based rates to carry the channels. It also secured rights to offer a skinnier package of channels for fans of sports, entertainment, and kids programming. The channels had been dark since September 1st for roughly 11 million DirecTV subscribers during those negotiations. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on this program, testing dollar dominance.
Now, much of the world would like to get away from the dollar, but what we are seeing is a curious phenomenon where the dollar remains very dominant in all of these respects.
That conversation just around the corner. You're watching Bloomberg TV.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
As as we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
We're doing okay. We're just about unchanged on the S&P. We're spoiled. Best week of gains on the S&P 500 this year, just last week. Sort of the same move on a Russell. Really decent week of gains as well on a Russell. Small caps participating, big tech participating. I have to say, Lisa, we mentioned this a couple of times. Financials, I think, maybe the weak spot last week. A bit of uncertainty around the signals we were getting from Ally Financial and JP Morgan alike in conference season.
It was sort of the 1-2 punch. Net interest margins under pressure at JP Morgan, and then questions around consumer creditworthiness on the other hand. It's sort of this difficult scenario that's hard to reconcile at a time where otherwise other signals seem to be really positive, both about the consumer as well as the broader economy.
Signals from the bond market and the broader economy. Broader economy seems to be okay, looking at jobless claims exclusively, specifically. Yet you're still going to get those interest rate reductions, anticipating what we might get on Wednesday. Bond yields this morning down just a touch on a 10-year maturity. The 10-year at the moment, 364.75. Under surveillance this morning, testing dollar dominance.
It's going to be difficult to shift away given the dominance of the dollar in practically every dimension as a medium of exchange, as a unit of account, and as a reserve currency. Now, much of the world would like to get away from the dollar, but what we are seeing is a curious phenomenon where the dollar remains very dominant in all of these respects. I think we will end up in a system where the dollar is still the most dominant, perhaps a little less dominant than it is right now, and there is a lot more fragmentation, which means there is no serious rival to the dollar.
So here's the latest. The US dollar falling to its weakest level of the year, with currency traders gearing up for a trio of central bank decisions from the Fed, BOE and BOJ. Skylar Montgomery-Koenig of Barclays writing, the dollar typically weakens ahead of Fed cycles. The move has already been chunky by historical standards. We're still at a stage when bouts of further dollar weakness are likely, but a large part of the dollar move is probably behind us. Skylar joins us now for more. So, Skylar, let's pick up on that last line. Why do you think the bigger chunk of the move might already be behind us?
Yeah, I'll give you a few reasons for that. I mean, the first is just positioning has shifted massively, right? We've gone from being max bullish long dollars on our sentiment indicator to max bearish dollars, and it's ticked up a little bit, but that sentiment is certainly still bearish. The other reason I'll give you is that you have previous historic easing cycles, and what you see is you do get dollar weakness into the first cut, but it's very front loaded. After the first cut, the market realizes that either it's a hard landing and you need safe haven flows for the dollar, and that supports the dollar, or it's a growth scare. It's not as bad as was originally thought, and that means U.S. growth is still strong, and that can feed positively into the dollar as well. And the main reason there is because in soft landings, the market overestimates how much easing the Fed actually delivers, and we think that's what's happening now as well. There's too much dovishness priced in the U.S.
So let's put aside for 1 minute the idea of Fed expectations and go to this question that was raised in the earlier commentary about what's the alternative? How much could the other side of the trade, whether it's a Bank of Japan hike on Friday with more hikes indicated later on, or potentially some sort of action from the Bank of England that is less than people had expected? I mean, the other side of the trade, how much could that send more dollar weakness?
Yeah, I mean, this is the hard bit, right? It's from a growth perspective. Certainly, there's not an impetus from the other side of the trade. Europe looks exceptionally weak. If you think about the U.S. and China as being the global growth engines, the U.S. is the only bit that's really chugging along right now. China isn't stimulating the rest of the world. It's not happening in Europe. It's not helping the UK, and it's, not feeding into commodities and thus these cyclical currencies like Aussie and CAD. I think on the interest rate bit, the big difference between the U.S. and Europe and the UK is they're significantly more priced in the U.S. And so I think the issue is because there's already that differential, you'd imagine that even if you expect more from the U.S., you need a closing of that gap in terms of more dovishness priced in Europe relative. And so, yeah, we are going to see less from these banks this week in terms of these are meetings where the Bank of England's not likely to cut. It's a meeting where the Bank of Japan is likely to stay on hold because they're assessing what happened after the hike. But, the growth backdrop isn't meant, or it's not pro having a divergence in policy to the extent that the market prices.
Skylar, how much does it matter to you whether the Fed cuts by 25 or 50 basis points on Wednesday?
Yeah, I think certainly for the dollar, it'll be quite binary for this week. In terms of the markets kind of pricing 50-50, we've had this rapid shift from the data indicating it should be a 25 basis point cut to kind of commentary and news saying that maybe it should be 50 basis points. And that means that when we get to this meeting, you could have a binary reaction where if it is 50 basis points, the dollar sells off. And if it's 25 basis points, the dollar rallies. Beyond that point, though, more medium term, it matters where the landing zone is. And that's the overarching theme that we're talking about in terms of we think we get to a 4% terminal rate. The market's pricing under 3%. It's very hard to price more than that. If you think we get a soft landing, then you think you're going below neutral, you're going into easing territory. And that indicates that you're thinking about a recession more, which should also be dollar positive. So yes, it certainly matters for the price action in the coming weeks, but I think more medium term, it's where the landing zone is that does.
Skylar, when you take all this into account, obviously everyone is laser focused on what the Fed does, but after that and the politics come into focus, what do you make of Trump talking about debasing the U.S. dollar?
Yes. So yes, Trump has called for a weaker dollar, but most of his policies are actually dollar supportive, right? And we think the cost of weakening the dollar would be too high. In terms of how he could, there are options. There are three kind of avenues you could point to. It could be fiscal consolidation, it could be eroding of the Fed's independence, or you could do direct intervention. On fiscal, I just think there's very little political appetite. On monetary policy, I think there are institutional checks that make it less likely. But I think we'd also say that keeping monetary policy unnecessarily loose would spur inflation. So that's, again, a very politically unpopular option. And then just on direct intervention, I think multilateral interventions seem unlikely because you have dollar counterparts and they're unlikely to want to take the export hit from a stronger currency. And then unilateral intervention, historically, it's not done very well, but it would probably also necessitate treasury selling, which would raise yields, which again is not something that they want to do as an option. And so any option that you could take to weaken the dollar, I think, is unlikely simply because it's too high a bar to pay to get there.
This call is not straightforward. Skylar, appreciate your input. Skylar Montgomery-Koenig there of Barclays on the US dollar in the next 12 months or so. Normalising interest rates is only one piece of this. Trying to understand White House policy for the next 4 years is almost impossible. Growth differentials and rebalancing growth differentials, I think, is the key point that Skylar's making there. There's nothing convincing happening out of China. Maybe it changes with fiscal policy, don't know. In Europe, there's nothing convincing happening there either. In fact, Europe faces the very real chance that they have to face what we went through in 2022 in this country with technology, but in 2025 they have to do it with autos. And if they go through some kind of auto recession where you have to see all that excess capacity get reconciled, get resolved, get cut, the job cuts that come with that, the outlook for Europe is not great at all.
This is the reason why arguments about debasing the dollar in this sort of dramatic way with central banks moving away from the currency have fallen a little bit hollow, because what is the alternative to take its place? People could go to gold, people can go to Bitcoin, but the reality is, as far as another major currency, hard to see.
Hard to see, very hard to see. Bit of dollar weakness again on a page on the screen right now. On the S&P 500 equity futures, just about unchanged. Let's call it unchanged. Going into a big week ahead. We've got a Federal Reserve decision on Wednesday. We've got retail sales tomorrow morning and jobless claims on Thursday to look forward to. Looking forward to the next hour of programming on this show. Savita Subramanian of Bank of America, Terry Haynes of Pangea Policy, Michael Harrigan of the Pax Group, and Krishna Mamani of Lafayette College. All of that and more still to come from New York City this morning. Good morning.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, I'm going to say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me. And I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching the close.
Get ahead of tomorrow's trading with The Close, weekdays on Bloomberg. Context changes everything.
It's almost a certainty at this point that we're going to get 3 cuts.
By the time we get to the end of next year, we're probably going to have seen somewhere in the region of 150, 200 basis points of rate cuts.
As we go forward and the cycle begins to ease a bit, that is going to take some pressure off.
The last thing they would want to do is overcut and then be in a tighter predicament.
The risk is if you go 50 first, the market will say, what do you know that I don't?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now on a 5-day climb on the S&P 500 and struggling to make it day 6. Equity futures just about unchanged, going into a massive week ahead, leaving behind the best week of the year and looking ahead to Wednesday. On Wednesday, a Federal Reserve decision in the mix. It's a 3-part act. You get the decision, the forecast, and the news conference. The day before, though, the economic data, Lisa, retail sales. Can this tip the balance, tip the scales towards 50 versus 25?
You know, last week I would have said absolutely not. We would have already been settled. And right now I'd say absolutely yes. This is going to tip the balance because it's ultimately we haven't been settled in terms of whether the weakness is enough for the Fed to cut. Doesn't matter, though. I keep going back to this Bill Dudley op-ed in Bloomberg, former New York Fed president, where he makes the argument for a 50 basis point rate cut, saying what should it do and what will it do, the Federal Reserve? The answers to these two questions don't necessarily have to be the same, but this time around, I think they will be.
And he talks about the logic of supporting a 50 basis point cut is compelling. My favorite note has to come from Michael Froley, though, saying that what the FOMC will do is less key. What we're sticking with our call, they will do the, quote, right thing and cut 50 basis points. Feels almost like a morality call.
Everyone's got something to say on this decision. Steve Major of HSBC with this to say: for all the talk around the Federal Reserve decision on Wednesday and whether it will be 25 or 50, we really need to know more about where the rate will settle in a year or so from now. You've talked about this repeatedly. What's the destination? What are we playing for here?
They didn't even want to talk, though, about a neutral rate in Jackson Hole. I'm talking about Federal Reserve officials. If they don't want to talk about the neutral rate, how do they speak about a destination when they haven't gotten clarity on exactly what this current economy is? Are they just going to declare victory over inflation over the longer term and say this is a non-inflationary economy akin to pre-pandemic? Or are they going to come out and say neutral rates 3.5%. That's where we're going. See ya.
Can you imagine if they did an ECB meeting by meeting and offered no forward guidance whatsoever? Brutal.
That wouldn't work, period. And that, I think, is what a lot of people are saying. They need to provide guidance. Their dot plot will provide guidance. And so then, to Bill Dudley's point, why not go 50 basis points and just say, we're going to cut by 100 basis points. We're going to cut 25 at the next few meetings unless there's some big shock. And we're going to front load it to get there more quickly. And that sort of gets ahead of arguments that might say, if you really thought the destination was 100 basis points lower, why not cut big now?
25 or 50, you will have plenty of arguments. That's just about all we can guarantee this week. If you are just tuning in, a lot of work to get through. On the S&P 500, equity futures just about unchanged. In the bond market, yields going nowhere. We're down to about 364.38. The dollar going somewhere, and that's south. The weakest US dollar of the year so far. Euro dollar at 111. Dollar yen, Lisa, a little bit earlier in the session, a brief break of 140 for the first time in 2024.
I keep going back to this statistics from Kit Jukes. The net longs from CFTC futures have gone to the highest level on the Japanese yen going back to 2016. To me, the whipsaw is just shocking. We went from a massive short position that led to the weakest yen in more than 2 decades to suddenly the biggest long position since 2016. This is a market that is very position driven, and you have to wonder how much that creates these whipsaws that don't create clarity.
Stronger Japanese yen on the screen, 140.08. Coming up this hour, Savita Subramaniam of Bank of America Global Research with a warning for big tech. Michael Harrigan of the Pax Group on the Ford assassination attempt on former President Donald Trump. And Krishna Mamani of Lafayette College on the odds for a soft landing. We begin with the big issue on Wall Street. US stocks looking to add to their best week of the year on bets the Fed will kick off the easing cycle on Wednesday. Savita Subramaniam of Bank of America writing, we remain underweight information technology despite arguments it has gotten so beaten up. Tech's concentration risk introduces the risk of passive selling, pressuring mega cap names. Savita's with us around the table. Savita, good morning. It's good to see you.
Good morning. Great to
Got to start with Wednesday, haven't we? 25 or 50. What's the house view?
House view 25, but I mean, I think we're all acknowledging there's risks of 50. I guess the idea is that our view is that the terminal rate settles around 325, 350. So that's what we're sort of tethering our market expectations to. The idea that inflation is cooling, rates are going down, but not to the lows that we saw pre-pandemic, to your point. So we're not going back to that sort of disinflationary environment where you've got, zero interest rates forever. And I think that's what puts pressure on tech and some of these areas of the market that are still very loved and very crowded.
So what should be loved? What should be a little bit more crowded?
I think you want to be in safe dividends. And I know this is the most boring call of all time, but sometimes boring is good. And, when you think about where we are today, we're in an environment where short rates are coming down. Think about all that money that's moved into money market accounts, retirees looking for income, looking for, investments they can live off of. As the Fed cuts, to 3-ish or wherever they settle, that income goes away, but inflation remains high. Retirees need real yield, and where we see that is in utilities, financials, real estate, in the S&P 500, areas that might not seem safe, but today I think they're higher quality than they have been in a very long time.
How did you make that argument last week when we were seeing, in particular in the banking sector, some difficulties?
Some difficulties, yes, indeed. So banks are not, the banks are always taking the hit for anything that's going on that seems bad in the world. But I think right now we are at a point where the yield curve is steepening. You've got the Fed telling us their next move is a cut rather than a hike. We've got an environment where financial services companies have a lot of levers to cut their costs. We've got, I think generative AI is a big kind of transformation story for financial services. For me, I fully expect to be replaced by a bot or a process. I mean, I think this is an area where we haven't seen any efficiency gains in a very long time. And we're now at a point where maybe we're at peak regulation, at least for the SIFIs and the big banks. We've got this new tool that allows us to analyze reams of data very quickly without, having junior analysts sit around overnight. I mean, I think this is a transformation for the sector. So I think there are a lot of arguments for financials, besides the fact that the big banks are the only area that are left to lend. If you think about it, if all these politicians want the economy to keep going, who's left to lend? Private sector, they picked up the slack and they're starting to show some signs of fraying. Regionals starting to fray. They've picked up a lot of the loan growth. the only area of the U.S. economy that's left to lend are the larger.
Can we speak to Brian directly?
Regulated banks.
I just want to speak to Brian directly. Don't replace Savita with a bomb. Don't do that. Is that what you're expecting? I hope that doesn't happen.
Actually, my question was, I mean, how many fewer people are they going to end up having? Actually, Deutsche Bank put out this report where they said that they had this proprietary model, ChatDBT, they call it informally, where they put basically the Wall Street Journal and the Financial Times articles in, and then it spit out what the bias was in terms of Fed forecasting.
Exactly.
But it gives a sense of exactly how much these banks are doing with it. I mean, how much do you expect some of these staffs to shrink over the next couple of years?
I mean, I think it's a good thing. I think that we're all going to be more productive. Those of us that are left
going on vacation.
but I think that, you know, like any technology, it replaces some jobs, but it creates new jobs, and it's exciting, right? I mean, when I look at the labor to sales ratio of financial services, it's only gotten worse. Every other sector has mostly gotten more labor light. Financial services has gotten more labor intensive. So I think this is an area that's, you know, kind of ripe for cost cutting, for efficiency gains. I think real estate is a really interesting area of the market. We've got dividends, we've got income. You know, when I think about retirees, my dad used to own REITs. Now he owns mega cap tech. I think we're going back to an environment where retirees own REITs, you know, MLPs, yield, utilities, and that's not, you know, one of the core holdings of the average retiree's fund at this point.
You haven't mentioned energy, and you say it's gone from value to value trap. Why?
Energy, I worry about a little. I mean, first of all, we're heading into an election where the outcome could be very different in terms of supply, oil supply. Second of all, when you look at CapEx to free cash flow, it's started to creep up. And I think we're in an environment where we want to be buying CapEx takers rather than CapEx spenders. So that's one of the areas where we're seeing free cash flow actually start to come down a bit. We're seeing massive earnings revisions. Our energy team, led by Francisco Blanch, is more negative on oil prices over the next 12 months because of supply and demand. So I think that there's an argument to be made that it's not time to buy energy. Deep value, it might be a little bit too early, but wait and see how the economy shapes up and stick with utilities as your way for getting exposure to commodities.
You mentioned politics. Were you surprised how well fossil fuel companies did under the Biden administration?
No, I mean, I think that this is what's kind of fascinating about energy is that it's done the opposite of what you would expect under each administration, right? I mean, under, you know, the Trump years were actually quite bad for energy stocks. And then, you know, under Biden, we saw energy really rally. I think part of it is just the fact that energy and oil was being assigned a terminal value of 0. Then we realized we're not going to get off of fossil fuels that quickly. There's also this sort of manufacturing renaissance taking place in the U.S. that puts some demand under, you know, commodities and oil. But I think let's say for the short term, I think oil and energy stocks look a little bit risky because the reason they look cheap is that prices have fallen faster than analysts have downgraded their earnings expectations. So that's the sort of classic value trap.
Zooming out, there's a real question about whether this market is fully priced a soft landing and whether the Fed can sort of keep that going, the last gasps of it this week on Wednesday with potentially a 50 basis point cut as well as some sort of forecast. How much can this market kind of rally given the fact, even with a soft landing, given the fact that you don't see big tech as a participant and possibly some of the other high flyers either?
Well, you know, our year-end target is 5,400, which is below where we are today. And I think the idea here is you see some give back in these stocks with high expectations that maybe are going to take a bit longer to deliver. But you do see kind of a re-rating in other areas of the market. So when I look at the landscape of size and style, I think large cap value looks incredibly attractive right now. Because first of all, when you think about where investors are going for income and yield, they're not going to buy small cap value, too risky. Large cap value is banks, it's energy, which we're neutral on, it's real estate, it's companies that haven't really had access to capital for a very long time. And now they're sort of trained to survive in a higher interest rate, higher real rate environment. I think the idea of navigating a soft landing is probably more feasible today because think about where the excess is in the economy. We're not seeing an environment where consumers are sitting on massive levels of debt. Corporations have actually taken advantage of low interest rates and have locked in fixed-rated debt. I think we're in an environment where the public capital markets look much higher quality. Maybe the risks have shifted to private lending, areas that are less liquid, real estate. I mean, I worry that if the Fed actually starts cutting and we start to see mortgage rates come down, that reset for home prices might actually be lower rather than higher, because we've been stymied by an environment of no price discovery in housing. Nobody's willing to walk away from their mortgages. So it's a weird world, but I think that things could do, we could be in a kind of an opposite environment of the typical easing cycle.
We've got one of those mortgages around this table, so we'll leave that there. I want to finish on utilities.
Yes.
Utilities are up by more than 20% year to date on the S&P 500. You mentioned the sector. It seems like this odd sector where it's everything to everyone. What is this trade? What are we getting into?
Look, I think utilities is sort of the steady Eddie. In fact, we have this chart that that my former boss, Rich Bernstein, used to publish that shows that the total return of the S&P Utilities Index versus the NASDAQ, almost always neck and neck. And it's really the idea that if you get this dividend and you reinvest it in these boring companies, right now maybe they're a little more exciting because of this power AI story, but I think you've still got this sector where you kind of know what's going to happen. They're regulated, they pay a high dividend yield. You reinvest that and you actually do just as well as you would in sexy tech stocks over the long haul. It's kind of an interesting analysis, and I think that's where we see a catch-up over the next few years.
You're certainly doing very well in that sector this year. It's good to see you. I hope you're never replaced. I will not interview the robot, OK? I promise that. Savita Subramaniam there of Bank of America Global Research. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Donald Trump is reportedly safe and well after a second apparent assassination attempt. Authorities took a 58-year-old man into custody at Trump's golf course in West Palm Beach, Florida. Secret Service agents had spotted an AK-style rifle barrel sticking out of a fence about 400 yards away from the former president, who was playing golf at the time. People familiar tell us that hedge fund Eisler Capital has lost about 10 money managers in recent days. The departures include people leaving voluntarily and those the firm has dismissed. Returns at the $4 billion hedge fund have been stalling as it attempts to transform itself into a multi-strat fund away from its roots in just macro trading. FX's Shogun broke records at last night's Emmy Awards. The feudal Japan drama won 18 awards in total, including Best Drama and Best Actress. That's the most for a series since 2008. Other winners include Hacks for Best Comedy, overtaking The Bear, and the surprise breakout Baby Reindeer winning Best Limited Series. The Bear, though, didn't leave empty-handed. It won many individual acting awards, including Lisa Colon-Zayas, the first Latina to win Best Supporting Actress in a Comedy. And that's your brief, John.
Danny, thank you. Shogun, nothing better. Just like right up there. Just absolutely brilliant.
I couldn't agree more. It's sort of Game of Thrones, just consolidated with more intrigue.
So good. And we get a second season, right?
I know, which I'm really excited about. But Marco's gone. So
I feel
really?
the same way.
Hey, I was like, the show is over.
Yet. No spoilers.
Sorry.
Up next on this program, that wasn't good. Another attempt on the former president's life.
Former President Donald Trump is safe and unharmed. The Secret Service did exactly what they should have done. They provided exactly what the protection should have been.
Another shocking twist in this campaign in 2024. That conversation just around the corner from New York City. Good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
This is an apology on behalf of the whole team at Bloomberg Surveillance as Lisa Brambett single-handedly ruins Shogun for everyone who hasn't watched it yet. Anything to say?
Including me.
I own it. Sorry. I'm like, come on. It just, I'm so excited.
You relate to it. I guess you just assumed everyone else had seen it.
Exactly. People, if you hadn't seen it already, you already got spoiled. So basically, this is, you're welcome.
Anne-Marie's sitting around the table thinking, I did not see it. I haven't watched it. And now I'm probably not going to.
Oh, no, I'm already getting hate mail. Sorry, guys.
Sure. Equity futures on the S&P look like this. We're just about unchanged. 5 days of gains on the S&P 500 through Friday, coming into Monday. In the bond market, yields settling down at about 364. In the FX market, the dollar at the weakest levels of 2024. Euro dollar 111.16. Dollar yen around 140. Under surveillance this morning, another attempt on the former president's life.
Former President Donald Trump is safe and unharmed. Following a protective incident shortly before 2 p.m. on Sunday, the U.S. Secret Service personnel opened fire on a gunman located near the property line, and this matter is under investigation. The Secret Service did exactly what they should have done. They provided exactly what the protection should have been, and their agent did a fantastic job.
So here's the latest this morning. The FBI investigating an assassination attempt on former President Donald Trump at his West Palm Beach golf course. Sunday's incident, the second one in 2 months, plunging the 2024 race into further chaos just weeks away from Election Day. Terry Haynes of Pangea Policy joins us now for more. Terry, it's another shocking twist in this campaign in 2024. What does it change, if anything at all?
I don't think it changes anything, John. And sadly, we have some precedent for this. Just about 2 months ago was the attempt on Trump's life. And I said then, and turned out to be right, that I thought that Trump wasn't going to get any lasting benefit out of it. I think that's still true today, largely because Trump has a hard voting ceiling. In other words, everybody that says they're going to vote that's going to vote for Trump is already saying that they're going to vote for Trump. So I don't think this makes much difference.
Terry, when you look at what happened, though, in Pennsylvania, 2 months later, another attempted assassination attempt on the former president's life. And then you have the Palm Beach County Sheriff coming out and saying, well, maybe if there was a bigger protective perimeter, this individual wouldn't have been able to get in. Why is he not being secured as if he is the sitting president? Not saying he is, but being secured on someone who does have these attempts on his life.
Well, I'm not going to pretend to be amateur expert here, but I was involved in a lot of the discussions about the Capitol perimeter after 9/11, but that's another story. I'm still not going to be Mr. Expert here. But Congress needs to get to the bottom of this. And by getting to the bottom, I mean that the relevant people on the committees need to come back. They need to immediately get briefings. They immediately need to figure out what the Secret Service did and didn't do and how to correct it. And they need to do all that within the next week or so. Throwing more money at this problem is not going to help if you can't figure out what the best perimeter is going to be. And Congress has an oversight responsibility that so far it isn't taking up with the alacrity that it needs to.
Do you think this task force is doing a good job, given the fact that it was built on a bipartisan basis from the first assassination attempt?
I'm sure they're getting a lot of briefings. I'm sure they're gathering a lot of evidence. I do think, though, that you get 2 months past the event,
you better know all the knowns and be ready to act on it, because we're in the middle of a presidential campaign, and we're in a situation where, heightened security, any incumbent President Biden, whoever the next president is going to need to respond to threats and need to anticipate those threats, apparently better than's been done in the 2 Trump attempts. And, I think the institutions of government here are not acting commensurately with the threat and the peril that's involved here for anybody, not just President Trump.
At this point, when you look going forward, how does this change the narrative, not necessarily for Donald Trump's campaign, but for Kamala Harris's campaign?
Well, I don't think it changes the narrative very much. I do think that at all, frankly, I do think that what ends up happening is that Harris continues to grind it out in the swing states and keep enthusiasm high. If there's any adjustment, I think they maybe adjust a little bit against personal attacks on the president or hyperbolic themes that may overstate his case. I'd bet on at least in the short term, a little subtle adjustment on that. And again, we saw that in July, but then within 2 or 3 weeks afterwards, which turned out to be the Republican convention, everything ramped up as if normal. Those adjustments may last a little bit longer this time.
Terry, given the fact that we have congressmen and women heading back to the Capitol today, what is your expectation in terms of them getting a CR through Congress and keeping the government open until the end of the year?
I'm sorry to say that I think what we'll see is the familiar scenario of brinksmanship, where a very few members see it as in their political advantage or in the party's political advantage to have some sort of performative shutdown. I don't think that lasts long. I don't think it's a big deal. So markets, I think, frankly, ignore it. But underneath, I want to point out to markets, too, that it emphasizes the unseriousness of what's going on in Washington. You have 2 political parties, one of which wants to continue to spend fiscally as it has done. The other political party thinks the idea of bravery is to cut 1% off of 30% of the discretionary funding. Neither is addressing the fiscal debt and deficit problem that markets are increasingly concerned about.
Terry Haynes of Pangea Policy with an important point to end things. Terry, thank you, sir. The important point here really is that whoever is in power, they have a very different view when they're not in power on whether we should be disciplined or not, with the purse strings down in Washington.
Which is the reason why Gary Cohn, who previously was the chief economic counsel director under Donald Trump, coming out and saying there's very little political appetite to increase the deficit. There's always political appetite to increase the deficit. This is the reason why people are watching when the bond market will push back, because until they do, it's going to be status quo, and that is what it is.
Well, to pick up on Terry's point, what they're fighting in Washington, D.C. is such a small sliver of the pie. This is where all the policy is done. But until they decide to go after what is going on with Social Security and Medicare, there's really no way to fix what's going on fiscally in Washington.
Bond yields this morning, at least, they're falling. They're not climbing. We're down 2 basis points on a 2-year at 355. On a 10-year yield, we're down about a single basis point. Your yield at the long end of the curve, 364 on 10s. On 30s, just short of 4%. Coming up on this programme, we'll catch up with Michael Harrigan of the Pax Group and formerly of the FBI as federal officials investigate a second attempt on Donald Trump's life. That conversation up next.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
How much hate mail are you getting?
I'm getting a lot. I'm really sorry. I didn't mean to.
Is it that serious? That sounded so sincere.
Well, it was sincere because I recommend still watch it. Let's move on. I feel really bad.
And there's a second season coming too. Enjoy it. Every futures right now on the S&P 500. Negative by 0.06% on the S&P. We're just a little bit softer on the Nasdaq. We're down 0.4%. The outperformance, just relatively speaking, again, you see it on the small caps. The Russell up by 0.6%. This in from Ian Lincoln of BMO. Odds of 50 basis points are increasing, and they certainly are, going into Wednesday, looking for the first interest rate cut since the pandemic and looking potentially for a 50 basis point move. Switch out the board and get to the bond market. The two-year yield declining last week in the face of a hotter CPI, a hotter PPI, and not a bad jobless claims data point on Thursday, and yet still, bonds rallied.
Buy the rumor, maybe sell the news, or buy the rumor and then also buy the news, basically. There was this shift, and whether it was a series of articles that came out in the Wall Street Journal and the Financial Times, or whether it was a series of potential officials and former officials who came out in support of 50 basis points of a rate cut on Wednesday. Either way, this is a market almost fully pricing it. They're fully 40% or a 40 basis point rate cut is now baked in at a time where the data doesn't show weakness, which is basically nirvana for risk assets.
The bias in the bond market is just phenomenal. The bias to buy fixed income every time yields back up. The bias to ignore strength and embrace weakness every time we get data in America. We'll catch up with Manny Roman of PIMCO in about 30 minutes' time on this subject. There is a massive bias to buy bonds in America over the last month.
Without a real question or without a real answer to what the destination actually is. And that really will be the key question on Wednesday. There is an issue of how much bonds can yield at a time where people are racing back to the bottom, even though a lot of people say we're still in an inflationary environment. It isn't necessarily 25 or 50 basis points on Wednesday. It is a question of that neutral rate that they're trying to get back to, and the fact we don't know what it is.
This move in yields unlocking some more dollar weakness. The US dollar started this morning at the weakest levels for the year so far. Dollar yen breaking down to levels we haven't seen since 2023. Dollar yen briefly south of 140. 140.07 on dollar yen. On euro dollar, 111.21. That's some euro strength and a ton of dollar weakness across G10 on the session this morning.
And this is front loading a lot of the rate cuts, in addition to maybe a soft landing type of scenario that allows trickling out to other currencies. It also comes with a potential Bank of Japan rate hike on Friday. There is this issue, though, of how far it can go, given the fact that there are a number of economic problems, whether we're talking China or whether we're talking about Europe.
And the outlook for tariffs and policy coming out of the United States. Under surveillance this morning, this story. Donald Trump's running mate, J.D. Vance, saying Trump's plan to hike tariffs on U.S. imports would help offset a growing list of tax cuts. Trump proposing to end taxes on tips, overtime, and Social Security benefits, along with a 10% across-the-board tariff that could spike up to 60% on goods from China.
I have a lot of questions about this, and I go back to what Lori Calvasina said, which is basically I left also the economic speech Trump gave in New York with a lot of questions on exactly his plans for tariffs and when it comes to his tax policies and whether or not the 15% corporate tax rate would benefit all U.S. companies or just those that have some sort of domestic component at home when it comes to manufacturing. But when it comes to tariffs, Trump said this in a Bloomberg Business Week article. He said, man, I'm so confused why so many people are against tariffs. It is good for negotiation. Will this be a blanket, quickly put the walls up around the United States and ring fence the U.S., or will this be a negotiating tactic, which Scott Besson told us maybe 2.5% on Chinese goods for 24 months until you get to that 60%?
Anne-Marie talking. Is there more clarity? I think not on your part, but with respect to policy, the answer is no. There is this issue of, can you really bank on anything from either side to create an economic policy, an economic narrative? And the answer is, for a lot of analysts out there, not so much.
There are many reasons to introduce tariffs. We've talked about so many of them to protect domestic industry. If you want to use them to influence behaviour, this is the question I would be asking people on the campaign trail. What evidence is there that tariffs in America across successive administrations have actually influenced the behaviour of the Chinese, particularly at a time when China is failing to get in line with the Europeans, with the Americans on very key foreign policy issues? The tariffs stayed. Have we actually displayed any success whatsoever in influencing Chinese behaviour? I would suggest very little.
Especially because there have been some backdoor
Terry,
ways
given the fact that we have congressmen and women heading back to the Capitol today, what is your expectation in terms of them
in
getting
auto manufacturers? The question's going to get a lot more difficult when it's not just blanket tariffs on consumer goods, but where you're talking about some of these high security aspects that recently they're increasing some of their crackdown on.
Should we talk about one of those loopholes? I had no idea this even existed. White House officials poised to crack down on the loophole, allowing low-cost goods to be imported from China tax-free. The US planning to begin taxing packages worth less than the previous limit of $800, a move directed at the rise of bargain shippers like Alibaba, Temu and Shein. I didn't know there was this loophole, but there you go.
To me, again, I was shocked that there was this loophole, and why does it exist? And I have to say, as much as some people, even in my own household, have gone to some of these and even gone to different knockoff brands to try to knock off some of the luxury players for cheaper goods from China, as much as they might lose out here, why is this in existence? Will this be difficult for them to get through at a time where it seems like a no-brainer? It just highlights, going back to the point we were making earlier, we say whether these tariffs have been effective, what are these crackdowns? There still are so many different apparatuses in place to make it easier for Chinese manufacturers selling into the U.S.
The reason why you guys don't know this exists is because you're not targeted by these cheap products, by Shein, especially in the fashion world, because you're not on TikTok, you're not on Instagram, and this is where they are starting to pick up these teens that want fast fashion at a really reasonable price.
That's why we're not shopping on Temu. No TikTok account. That would change.
Evidently. I'd be a lot hipper if I had a TikTok account, evidently.
Possibly. Lisa's still apologising, by the way, for those of you just tuning in for completely spoiling
Oh, my God. Are we going to do this all morning? Just keep bringing it up again and again?
Ruined it
Possibly.
for me.
Okay.
Possibly. Let's turn to a much more important story. The FBI is investigating a second assassination attempt on Donald Trump at his golf club in West Palm Beach, Florida. Secret Service agents reportedly spotting a rifle barrel sticking out of a fence before opening fire and apprehending a 58-year-old suspect who is now still in custody. Joining us is Michael Harrigan of the Pax Group, who is also a retired FBI Farms Training Chief. Michael, welcome back to the programme. I'm happy to catch up with you, sir. Unhappy to be speaking about the same subject again just 2 months later. Michael, just tell us from your perspective why it's proving so difficult to secure and provide security for the former president.
Well, Mr. Trump, he moves around as he likes. I mean, obviously he's under Secret Service protection, but, he likes to get out there. He's known to love golf, outdoor venue. I think what you have here is you have to look at each threat and each attempt independently and look at what the background of these are. And both seem to be where there was some planning, and it was a point where he was vulnerable at that moment. So it's a tough one here to have two so close to each other, or should I say two on one candidate. That's unheard of. And this points to a very high threat level for the former president, and one that may call for rethinking his security and for Mr. Trump potentially to rethink how he goes about his daily life.
Well, Michael, that's what I wanted to ask. When you look at the near term right now and protecting the president, is it about changing his schedule or potentially changing some of his habits and what he likes to do? Or is it about changing the Secret Service?
You know, that's a two-sided knife there. Both sides have to be assessed. But, you know, when you come down to it, if you're not the number one thing for vulnerability, if you're not available to be attacked, that's your primary defensive measure, not to be where you could be attacked. Now, the Secret Service, again, they took a very hard look at them. You know, Congress and American people have been asking questions about Secret Service since the Butler incident. On this situation, though, we don't know enough yet. It sounds, from what we can see, is that the Secret Service performed phenomenally in interdicting this threat before the man could take the shot or take an effective shot at the president. So Secret Service did well here. But I think you have to look at the overall structure of where he was, a public street. Anybody can stop a car and jump out anytime. This guy obviously crawled into the bushes where he was concealed. So, you know, I think that both sides have to be looked at. But I think the primary thing here is for Mr. Trump to consider changes to his schedule now, however uncomfortable he might find that to be, and remove himself as a potential target out.
Well, this individual's 300 to 500 yards away from Trump while he was golfing. And the Palm Beach County Sheriff said yesterday that if Trump was the sitting president, we would have had this entire golf course surrounded. Should they have done that? Should they start expanding the perimeter?
Well, I think it's a duality here, again, is that, Secret Service has to obviously make some changes in how they might protect him if he's on a golf course. And I can guarantee you that from this point forward, he's not going to be in this position on a golf course. Secret Service is going to step up and do what's needed. But, you know, you look at the balancing the public inconvenience of shutting down those major roads there in that area. To shut those down while he's playing golf is a huge inconvenience to the public. Obviously, in light of this situation, a reasonable cost to be paid, though, a reasonable cost. So, you know, both sides have to be looked at. And, frankly, Mr. Trump may have to listen closer to his Secret Service advisors there and just make those changes, at least in the lead up to the election. It's only a couple months away. Obviously, he's got to get out there and go to his rallies and engage with the American public. That's what he enjoys doing. So that can't be interfered with. And they are taking very good measures there when he's in public at official events. But it's these private events like this where he's so-called off duty on his own time that now we see how vulnerable that can be. And it's a lesson to other presidential candidates out there for them to reassess how they go about their personal lives. It's a very frustrating time in this country to see this happening, and it's a critical time for us to maybe make some changes.
Given your prior work at the FBI, do you think this individual was watched? That given the fact that he, according to his Twitter account, which has now been shut down, has gone over to Ukraine and he claimed he was fighting on behalf of the Ukrainians. Was this individual, do you think, flagged previously by the FBI?
You know, he could have been, but when you look at the breadth and depth of people that travel overseas or may have political views, I mean, it's a staggering amount of persons that could be potentially looked at by the FBI and maybe a file opened on them. Nothing substantive can be found because it's simply First Amendment speech. So then it's moved on, and they move on to other more relevant, more current threats. So just the fact he traveled overseas probably isn't a point of the Bureau looking at him. It would be more of what he's saying and what his footprint is on social media and what he said maybe to, in the public arena in other ways, whether he's a threat or not.
Michael, just to go back 2 months,
to Ukraine.
If I can jump in, sir, if you don't mind.
Yes.
Are you surprised
Absolutely.
how little we know about the motive behind the first assassination attempt only 2 months ago and the lack of detail between then and now? Are you surprised by how slow this process seems to be going?
To a point, I mean, I think the primary point here is to find out if both these individuals had connections to a foreign government, to a larger conspiracy. But unfortunately, what you see in some of these, what we call lone wolf actors here, that act on their own motivation, they may have minimal communication with others that could become a red flag and a chance to report and interdict these threats. So these individuals are out there. It's the same with the individual that shot at the Republican congressman on the Hill. He wasn't able to be interdicted beforehand because he was a lone wolf. He was on his own, decided to do this on his own. And same with these. Very difficult if they're not having conversations with others and talking about their plans, you lose that opportunity. Or if they're part of a conspiracy or a group that's under surveillance by the government, then the government has the opportunity to look at those communications and potentially stop these threats before they materialize.
Michael, we hope we don't have to have this conversation again. Michael, thank you, sir. Michael Harrigan of the Pax Group and formerly of the FBI after a second attempt on the former president's life in just 2 months. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The yen is around its strongest level in over a year. The currency appreciating for a 5th consecutive day. It did briefly fall below 140 versus the dollar this morning, but is now back just about at 140. This morning, it's mostly the dollar side moving on nearly even odds for a 50 basis point cut priced into markets. The Fed's decision comes Wednesday, the BOJ's on Friday. Intel shares higher pre-market by over 1%. People familiar telling us that the chip maker has officially qualified for as much as a $3.5 billion in a federal grant to make semiconductors for the Pentagon. That would add to a possible $19.5 billion in grants and loans awarded to Intel through the Chip and Sciences Act. As of the Friday close, the stock has fallen some 61% this year. Now, those $8 lattes may become more commonplace. The cost of premium Arabica beans this morning surged to the highest level in 13 years. Coffee futures as a whole have surged around 40% this year. There's been shortages of the cheaper Robusta beans, and that's boosted demand for the premium Arabica variety favored by coffee buffs. There's been concerns also about harsh weather in Brazil that's fueled the rally. Brazil currently grappling with its worst drought in decades. And that's your brief, John.
Danny, thank you. More from Danny in 30 minutes' time. Two views, two very different takes. Earlier on this morning, the former New York Fed President, Bill Dudley, making the case on Bloomberg Opinion the Fed should go big now. I think it will. Moments ago, Steve Englander of Standard Chartered, good reasons not to cut by 50 basis points. This one, I keep saying this, it is so finely balanced going into Wednesday.
And a real question of whether it matters ultimately, given the destination, how much they can telegraph that, given they will have a dot plot, they will have a statement of economic projections.
Up next on this program, a split decision.
We're looking for a 25 basis point rate cut, but for them to really signal they're going to do a sequence of cuts here. A 50 basis point cut, it suggests to us that they're more worried about downside risk to the economy.
That conversation around the corner from New York. You're watching Bloomberg TV.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
You're going to get this all week. This from Steve Englander of Standard Chartered. Good reasons not to cut by 50 basis points. The economic data has not made a compelling case for a 50 basis point cut at the upcoming meeting. Goes on to say cutting by 50 and being wrong would likely be worse than cutting by 25 and being wrong. What do you make of that argument?
It's arguably the exact opposite from what a lot of people are arguing. So you can pick the argument you like. You can make an argument either way. Problem for me is how much does it matter if you do understand the path, if you do understand how much they're going to cut this year? But then the second question is, if you think that 50 basis points of a cut is going to be the bigger mistake, does that mean that you think that inflation is still very much a risk, lurking beneath the surface, ready to rear its head once more?
You'd have to imagine that's what he means by being wrong. You'd have to imagine that might come up on the FOMC in the debate over the next 48 hours or so. Equity futures right now unchanged. Going into all of this on the S&P 500. In the bond market, down almost a basis point. The 10-year 364. And in the FX market, as we've said all morning, the dollar near the lows of 2024. Euro dollar 111.23. Under surveillance this morning, a split decision.
The Federal Reserve should be focused on moving policy rates back to neutral. And I think the question at this point is just how quickly they get there. We think they probably will revise down their own estimates for the rate path. In September, we're looking for a 25 basis point rate cut, but for them to really signal they're going to do a sequence of cuts here. A 50 basis point cut is if they end up doing it, it suggests to us that they're more worried about downside risk to the economy.
So here's the latest. Treasury's gaining with all eyes on Wednesday's Fed meeting. The debate on Wall Street now 25 versus 50. Christian Mamani preach. I hope they trot somebody out, set us up for a 50 and relieve us of our misery ahead of the meeting. Somehow I don't think it's likely. If we're going to have a hard landing, 50 won't stop it. It is too late for that. Krishna joins us now for more. Krishna, I just agree with you, sir. I think we all do. This is getting tedious. This from Steve Englander, and I want your thoughts on this, and welcome to the show. Cutting by 50 and being wrong would likely be worse than cutting by 25 and being wrong. Krishna, what do you make of that logic? Do you agree?
Well, so I think the point Steve is not articulating is the fact that the Fed is bound by its mistake in 2021. That is, in their minds, if they cut by 50 and you have reacceleration, that's a bigger challenge than if you have if they cut by 25 and things continue to slow down, because they believe they have a lot more space to cut rates over the next 12 to 18 months. However, if there's a reacceleration, it's on them altogether. So I think that's what the Fed is dealing with rather than the economic reality.
So what is the economic reality, Krishna? I mean, this has sort of been the big mystery, so that ultimately is really what's going to be at stake in terms of determining the path of risk assets.
Yeah, so I think Dudley today articulated the economic reality quite well, which is, look, growth today is quite decent, 2.5% GDP now. Inflation has come down. Relative to inflation, short rates are too high. They can cut 50 basis points. Whether they will or not is really the issue. Is there enough room in the rate structure today for them to be aggressive and cut? Absolutely. Is there weakness enough for them to kind of go whole hog? Absolutely not. And I think that's the challenge that they're dealing with.
What does whole hog mean, though, Krishna? I guess that's really the key question, given the fact that people are saying, some people are saying 50 basis points would move the needle on what market expectations were for the full year. Bill Dudley's argument is if you think that neutral is substantially lower than where we are now, why not get a rapid start to it? Otherwise, why aren't people going to ask, if you think neutral is 150 to 200 basis points below where we are now, why not move a little bit faster to get there?
Oh, absolutely. I think, again, they have the room to move faster. However, I think, as Dudley also argues, is the fact that they got a head fake in the early part of this year. And they don't want those head fakes because that would, doing a 50 ahead of an election, then end up with a head fake would probably be far worse for the credibility of the Fed than anything else. But as you have been articulating, that's really besides the point. I think they will articulate a very aggressive rate cutting path. And I think in the end, that probably matters a whole hell of a lot more than anything else. What we are dealing with is a situation where inflation is coming down, rates are high, economy is doing reasonably well. So there's a negativity vacuum, and we are trying to create some drama in the middle of all of this.
So, Krishna, let's get the market call. Let's think about how far bonds have moved. The 2-year topped out just north of 5% earlier on this year. I think back in spring, back in April, we've had a move of about 150 basis points lower at the front end since then. We've had a round trip in equities. Call it a growth scare, call it August, whatever you want to call August. We're back close to all-time highs on the S&P 500. Krishna, given those moves, as you start to think about the balance of risk into year-end, more upside risk or downside risk? What is the bigger risk for you?
So I think as far as bonds are concerned, at these levels, unless you think we are really going to have a recession or that probability goes up, I think the upside, that is lower yield upside in bonds is limited in my judgment. And you know, it's not that we are probably going up meaningfully higher. It's just that we just sit around here for a long period of time. Having said that, I think if actually probability of recession increases, and we won't find out till probably middle of 2025 whether that is the reality or not, rates can move very, very substantially. I think the challenge with equities is the valuation. You know, the environment is right, but environment is right along with the fact that we have already incorporated all of that information in our pricing. So upside is limited there as well, and a recession, the downside is quite substantial.
So what does that mean you're doing, Krishna?
I'm sitting tight from a risk perspective, and has been the case for a few months. Hasn't worked out too badly with the special emphasis on bonds. That is, if you had some spare money, investing in bonds makes more sense because it can run away from you. Equity markets are not going to run away from you.
Krishna, just quickly, invest where in bonds?
Invest in the short end of the market. I think still. Cash is yielding pretty good, and at this pace, it'll yield pretty good for a reasonably long period of time. And if you don't, if your expectation is that we are going to have a soft landing, which is the case for me, the upside in buying longer bonds just doesn't exist anymore.
Okay, Krishna, thank you, sir. Appreciate your input. Good luck for the rest of the week. Try and get through it. Krishna Mamani of Lafayette College. I think we all feel the same. Peter Cheer feels the same too over at Academy. Good luck. I wish the Fed would come out at 10 a.m. Eastern time so we'd have less time to second-guess every position and view.
Basically, we're all sick of this conversation, and yet we're going to be having it for the next 48 hours. I do want to just note that what Krishna just said there was not what a lot of fund managers want to be hearing. You know, stay in money markets.
They've got things to sell.
I mean, they've got things to sell, and this isn't working for them.
If you find this tedious, wait until the next one. November 7th, that's going to be quite a meeting for the FOMC. 2 days after the general election.
Yeah, I don't know that that's going to be tedious, though, because they're going to have to take a look at who won the election and what the economic projections most likely are going to be at a time where that also is an uncertainty vacuum. I mean, negativity vacuum. I love that idea. I hope we stay in a negativity vacuum for
I hope we know who won the election 2 days after the election. That might be wishful thinking.
It might be wishful thinking because some of these states cannot start counting their mail-in ballots, notably Pennsylvania, until the election is over on November 5th, so it might take a few days.
Coming up on this programme, here's a lineup for you for the third hour of Bloomberg Surveillance. Manny Roman of PIMCO, don't miss that. Greg Dacko of EY, Megan Robson of BNP Paribas, and Bloomberg's Ira Jersey. It's a big week ahead. The third hour of Bloomberg Surveillance up next.
Well, I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investments that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system. We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issues, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient, while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. The top names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close.
Incoming mail.
Is on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
There is a real risk the Fed is falling behind the curve here.
This Fed tends to move slow. They're watching with a rearview mirror.
The recent loosening in labor markets just suggests that there is some possibility for overshooting.
It's now about next year and the year thereafter where there's much more uncertainty.
It's not just that we don't know what the destination is. We don't know what the journey is.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now with an absolutely fantastic lineup for you. Equity futures on the S&P 500 just about unchanged, coming off the back of a 5-day winning streak and involving the most tedious debate of the year so far. It's become tedious, that's for sure. 25 or 50 at the Federal Reserve on Wednesday.
The reason why this is so tedious, let's examine the tedium that we have to discuss for the next 48 hours, is because we also don't know how much it will matter. Because ultimately, it is not just about 25 or 50. It is about how the market responds to it. It is about how it is telegraphed going forward. It is about the destination. It is about how Jay Powell dresses and how he sort of intonates when he gets to the press conference.
I used to do that with Draghi ties. Do you remember that? Yeah, and then it became Lagarde scarves and stuff like that. Just ludicrous stuff. Things are so finely balanced. There is a real belief on the street right now that a soft retail sales print or a firm one could tip the scales in one direction or the next. We've got retail sales tomorrow morning, and then we've got jobless claims on Thursday. Is that going to be what tips the balance here into Wednesday?
Well, it's because the market was pricing in 25 basis points after the jobs report, after inflation, and now all of a sudden, after an FT, a Wall Street Journal article, and we should note Bill Dudley's comments and an article in Bloomberg Opinion, now the market is pricing in 50 basis points. Potentially the next shoe to drop where they can maybe change their position will be retail sales.
The former New York Fed president making a case in Bloomberg Opinion to go big, and he thinks they will. It's not just a case to go big. It's that he thinks they will go big on Wednesday afternoon.
He cited the articles in the Wall Street Journal and the Financial Times as a good sort of sense of how the debate was evolving, talking about how they could avoid getting criticized for not getting to the destination more quickly if they went by 50 basis points. If you take a step back, it goes to this question of what is the bigger risk here, inflation or employment? Pretty much everyone thinks that right now, at the moment, it is economic weakness or economic potential softening. On the flip side, Neil Richardson talking about what we see in housing prices, what we see with household wealth, what we see with sentiment. It's sort of tricky to know.
At the moment, right now, there is a belief that it's more likely we get 50 than 25 based on market pricing. Coming up this hour, this is the lineup for you. Manny Roman of PIMCO. As markets await this week's Fed decision, we'll catch up with Greg Dacko of EY on why he's expecting 75 basis points of cuts before year end. And we'll speak to Megan Robson of BNP Paribas on why she's bearish on credit going into the election. We begin with a big issue on Wall Street, 25 or 50. Bond yields falling going into this week's finely balanced central bank meeting. The PIMCO team writing the post-pandemic inflation shock and rate hiking cycle produced a generational reset in bond yields. Central banks have largely succeeded in bringing down inflation to 2 point something and are poised to begin cutting rates, creating a compelling multi-year outlook for global fixed income. I'm pleased to say that the boss over at PIMCO, Manny Roman, joins us now for the next 30 minutes or so. Manny, it's good to see you, sir.
Good to see you.
Good
Thank you for having me.
Put us out of our misery, 25 or 50 tomorrow. What's it going to be?
Well, we're in the camp of 25, but, you know, I always say we have a crystal ball, and at the end of the day, we'll see what the market does. You know, it may very well be that it doesn't make that much of a difference, and our view is that there will be 3 cuts of 25, and at the end of the day, what matters is where we are at the end of the year.
Well, let's talk about the destination. This is a 3-part act on Wednesday, as you know. It's a decision, it's a set of forecasts, and a news conference, and a big conversation around this table.